Okay, Rashmi ji, you can start with the second day of first presentation.
Thank you, Puneet. Happy morning, all. This is Rashmi Patel, and the stock I'm going to present is Kfintech Technologies Limited. When I said that Kfin, you have heard of CDSL, you have heard of CAMS, CAMS stock, but have you experienced one of these things? You have been investing in the mutual fund, you have been investing in SIPs, you have been allotted IPO or not allotted IPO, you are applying for the rights issues, you have been asked to update your KYC by your bank, you have been given your dividend payout, then you got your capital gain statement, you are checking your watch list, holdings, console, P&L, everything. Who do you think is doing everything for you? Like the company you're invested, say you're applying for the upcoming IPO, do you think that company will update you all the emails and the interface between you and the company? Certainly not. So if you're investing in a mutual fund, then that company is only providing you a service of updation of the fund and nothing to do with the service of how to update you on upcoming any kind of information that you need to have. So here comes a third party called RTA, that is registrar and transfer agent. So the companies that you're investing or who is managing your funds or through whom you're applying the mutual fund is your AMC, that is asset management company, and RTA is the registrar transfer agent who acts as an agent between you and your company you're investing in. So what exactly the RTAs do? The SEBI compliance, like you have any kind of SEBI mandatory thing to follow on, then manage your client data, process your KYC, update all your fund data into your email and then send you a summary of it, resolve your queries when you're connecting, when you're trying to connect with your investor, then allotment of IPOs, whether you're allotted, you're not allotted, the refund is done to you, all kind of messages that you're getting into your email as well as your WhatsApp or anything that you're connected to. Then there are certain apps sometimes, like suppose you have your SBI bank account, then you are connecting to the customer care, not through the call anymore, but through the app, through WhatsApp. So all these things and maintaining your folio where you're given your a number to just like a bank account number. So all these things are maintained by RTA, not AMCs. AMC only provide you the information about the funds and try to give you the best returns, but not interaction. The all kind of interaction between the AMCs and you as a client is done through RTA. So AMCs are B2C. That means they are business to client connected, whereas RTAs only work for the AMCs. That is the company which are providing the service to the customer. So what exactly RTA is? By definition, it's a financial institution that acts as a record keeping and processing service provider for mutual fund houses and investors. And how do they exactly earn from it? So any kind of SIP you do, any kind of mutual fund you apply or invest in, the amount you are investing, the number of transaction you're doing with the AMCs, for everything, the AMC is charging from the the RTA is charging from the AMCs. So whatever fee you are giving to the AMC, part of it will always go to the RTA. So when it comes to major RTA, there are many RTAs, but two major RTAs that are listed in stock market are CAMS and Kfintech. That is, Kfintech is what I'm presenting today. CAMS has been listed since 2020 and Kfin has been listed since December 2022. You can take it as 2023. So it is 2.5-year-old company. So Kfintech was founded in 1983 Basically, it is the part of Kfintech group, but Kfintech group got into some problem, so they separated themselves from the main company, that is Kfintech, in 2019, and got listed into stock market in 2022. It is based in Hyderabad, whereas the CAMS is 1988. Rather, it is this company is older than CAMS. So that is based in Chennai, and it was listed in 2020. So what exactly Kfin does here is, it is the second largest RTA. So who is the first largest RTA? Is again the CAMS. So second largest RTA, and it has servicing multiple financial sectors. So it acts critical as a back-end service provider for mutual fund companies, handling new investor onboarding. Like you're investing for the first time into the mutual fund, you're opening your first time demat account. So when you connect with your AMCs, you'll be given something called as folio number. Just like you open your bank account and you're given a bank account number, unique bank account number. So is the folio management, that is assigning you a unique folio number. Then transaction handling between your mutual fund, buy, sell, switch, whatever you do. Like once you are into investing, then you want to switch your mutual fund, you want to change your SIP, anything that is done, again, the transaction handling is done by RTA. And account statements and reports, whatever you ask them, like weekly, sometimes it is monthly. So whatever records, I mean reports you are getting into your emails, again, it is sent by the RTA. And dividend and deduction payouts, like some companies give the dividend. So whenever the dividend is up, the information that dividend will be given, that information that you are credited with your dividend, everything is done by, again, RTA. So it is basically data management and compliance company. Here, very specifically, they handle the mutual fund transaction processing, like your SIP, STP, SWP automation, everything, whatever comes under mutual fund. Then record keeping. It maintains a detailed record of an investor. Once you are into an AMC, from the day you invest till you completely take out your, investment from that, the complete record maintenance is done by RTA. And investor servicing, like any support you need, like the interaction between you and your AMC, so that servicing is done by RTA. Then KYC, repeatedly, like every 6 months, sometimes every 1.5 year, the banks or the AMCs ask for KYC. So this KYC updation is also done by RTA. Then data reporting, analytics, and supports your financial advisors, distributors with your tool. Then corporate actions, it is just not about individual investor who is investing and then getting the updation. It is about the corporates who are investing hugely into certain companies. So even including your IPO, rights issues, the bonds you hold, everything, allotment, refund, all the kind of information that you're getting, that ease of knowing your company is done by the RTA. So here is the company's milestone. It was launched in 1985, and then it started just as a mutual fund solution business. Then it got transformed itself into as a wealth management business. Then it got into the pension scheme. Then the investor solution, like they try to spread themselves into Southeast Asia. But in 2019, General Atlantic is a company that bought 83% of the shares of this company and become the main promoter. So here on, the new CEO was appointed, and everything was changed. But at the same time, the company was having problem with its parent company, that is Carvi. So they got separated in 2019, and then a new CEO was appointed, and the Kotak Mahindra Bank, which is a DI, which holds 9.9 stake in this. So many changes occurred since 2019, and 2022, they got listed into the stock market, and it has been created as AA. Mr. Venkat Satya Naga Shrikant Nadella is the CEO and he has 22 years of experience. So does the other like Chief People Officer has 25 years of experience. Gopal Krishna has 27 years of experience. So everybody involved in this company have good enough experience and they are the promoter holding the chief positions in this, including the directors. Only 2.5 years, but the company recently has won the contracts of 17 new AMCs, that is from Axis Mutual Fund, Bajaj, Baroda, Bank of India Mutual Fund, then Canara Robeco, Edelweiss. These are all very good mutual funds. Particularly the Nippon India Mutual Fund is the biggest one. So this is also under, I mean, the servicing is done by the KFIN. And these are the other major names, the clientele of the KFIN technologies. That is Aqua, you have heard, Mama Earth, you have heard. So Biocon, all these things, Rapido, and all these things have been, I mean, the service is given by the KFIN. So looking KFIN at a glance, we'll just see that what exactly it holds. So largest investor solution provider in India for mutual funds. Out of 51, 26 AMCs are already taking the service of KFIN. Recently, another 17 out of new AMCs that have been launched that I just showed here. So all these are taking the service of this KFIN technologies. Then you can see that equity mutual fund, that is AAUM. AAUM is averaged asset under management. So that is 33% of from FY20, and monthly SIP inflow is almost up by 40%. Once this company already possesses 170 million, including Indians and outside investors, and it has 50% market share, and then corporate clients are almost 8,000. And here, right now, they are managing 164 million investor folios. And international other solutions is that internationally they have 76 clients, including 12 new clients yet to be joining them. And 1 out of 3 operational CRAs, that is NPS, with 1.6 million subscribers, totally accounting to 3 crore. And here 569 AIF. AIF is nothing but your alternative investment fund. And here it is like has to its credit, that is big site security score. What is big site security score is the score is given between 250 to 900, and this company has scored 810 out of 900. So KFIN is considered among the highest in financial ecosystem, means it is stronger security position and lower risk. So this company is taken as lower risk and high provider of security because your all information is maintained with this company. And it is processing daily, it is managing daily 2.4 million average transactions. Recently, the company within this quarter, it acquired Ascent. It is a Singapore-based company which was started in 2019, and it has a client base throughout the world. So this company is based in Singapore. Its headquarters is in Singapore. Right now, KFIN has 51% of stake, and it is going to acquire this company 100% by the end of 2030. That is in next 5 years. And it has global presence in 13 countries and offices in, 23 offices. And it has 6 regulatory licenses along with these. These are the 6 licenses. And it has clientele that is 576 live funds across 18 countries. Kfin, though is a Indian company, it is almost like it has already 50% acquired and it is going to 100% acquire this company. So whatever clientele this company has, wherever base or expansion this company has, that advantage will be taken by Kfin. And fund domiciliation, that is where the fund, like if there is any problem later, then jurisdiction, where that fund jurisdiction should be. So 45% is in Singapore, then 12 uh, like Saudi Arabia and all, they have mentioned it. And here the revenue of only this Ascent company, I'm telling, not Kfin. So here it is 32% year on year up, and 2 year CAGR is 34%. Recurring revenue itself is 92%. You can imagine how much value this company will add to Kfin. So, since they have joined hands with Kfin, the good thing is they have now the global expansion. Kfin has the clientele in throughout the globe now. That's the 13 countries this Ascent already have. So, acquisition helps deepen the Southeast Asia and opens opportunity to expand into larger markets, that is including US, Europe, and other Southeast Asian countries. Sorry. And the combination here, the Kfin's base, like the data sheet of Kfin is so good, and the global market of Ascent is so good. So for both, it is win-win situation. And Ascent's ability to service multi-asset class across complex investment strategy will again strengthen the Kfin market leadership, because KFIN is not just handling mutual funds, and nor does the Ascent. So they are diversifying their services. Later, I will explain them what exactly it is. So this helps them approach more people, more corporates. Here, you can understand the market of KFIN, the corporate issuer services. What you mean by issuer services is like you have you hold a credit card, you hold a debit card, so or you have been allotted a IPO or been not allotted, but that anything like you hold anything prepaid. So anything related to corporate services is a issuer service. Your issue is being resolved between your AMC and your corporation. So if you are a company dealing with, I mean, putting your money into the AMCs or investing into the AMCs, so that is called issuer solution. So this service is provided by the KFIN, that is, it has 38% of the listed corporates under it. And alternative investment funds, what is alternative AIF is like you are having good enough of money, and you don't want the normal mutual funds to be invested, or the general thing, nor the SIPs you want to go to. You want customized thing for you, not the regular mutual funds that are running in the market. So when you prefer the customized service, that will come under alternative investment fund. So even that is 37% market share is held by KFIN. And national pension scheme, this is growing now, so this also 10% of the share is under KFIN. Mutual funds, it holds less because almost 60-65% is under CAMS, because it is a older company than this, and it is another competitor and the only RTA equivalent to KFIN. So 65% of the mutual fund services by CAMS and 35% is by KFIN. And international expansion, if you consider there are 76 clients already across Asia. Gift City is nothing but Gujarat International Finance Tech City. Then Canada, presence in Malaysia, Singapore, Philippines, UAE, and all. And 60 plus RTA contracts with 40 plus fund admin mandates are already under KFIN. And you can see here FY25 already it is 4.2 million transactions. Here it shows the global presence of this company. I mean, since it has acquired Ascent, so its presence now is in all the Middle East countries, including Canada in the West. And here the number of clients you can see growing. FY24, it had 57, whereas you can see the growth in FY25, and this will keep growing. RTA solutions, what are given is number of contracts they have is 60, but whereas the fund administration of any company, they have 40. So overall, average asset under management in terms of billions is it has been growing 33% till date from FY21 if we compare. So there's a growth of 33% year on year compared to last year only. And the transaction volume is up by 16% compared to last year. Talking about the quarterly results of Kfin, number of clients, when we talk of Kfin, it is only 2.5 year old company. So from 24 till 25, you can see the growth, and it has one multi-year fund administration platform deal from a large trustee and 8 AMCs and 6 out of 10 pension fund managers in India using Empower platform. What is Empower? It is a KFIN service. It is nothing but the wealth management platform. That means it is a software that is given to individual or else the corporate. They can use this app, they can use this website and then resolve their queries or interact with the AMCs. And number of subscribers and market share, you can see from FY21 to FY25, year on year growth itself is 32%. So market share of new subscriber addition in FY25 alone is at 19%. Kfin's subscriber base grew 32% year on year versus 12.2% year on year growth of the industry. And every single quarter, new subscribers have been added. And 398 corporate clients during the last quarter. Overall corporate client base is 3 crore 337. When we talk of domestic mutual fund investor solutions, focus on mid-size equity AMCs providing significant sustainable advantage. You can just see here overall asset management and market share, it is growing by 32%, whereas equity and market share, it is also going by almost same, that is 33%. So what has Kfin making profits out of it is 25% year on year, but the last quarter have not been so good for Kfin, and so with the other companies also, because almost 78% people withdrew their SIPs, particularly who were new into the market. So go quarter wise, then it is down by 2.2%. But if you go year wise, again, it is up by 26%. And you can see here SIPs, only the one quarter, there is 308 billion inflow of SIP, new SIPs. So year on year growth again is 36.8 up. And new live folios, the number of folios they are maintaining is 43.4 million, and the profit for Kfin is 22.2% up. And it continues with the net flows, that is Kfin itself grabbed almost 70% of the industry's net flows. And here comes the new fund offer market share. Here also it is 38% up. So overall, when you see, Kfin is being benefited because the SIPs are growing, the mutual funds are growing. I mean, people are being aware, they started investing. But in worse times, like just like the last quarter, when people are confused where to put the money or to completely withdraw, the quarterly result is down. So issuer solutions, as I said, issuer solutions is something that corporate has any kind of issues or queries that they want to connect with the AMCs. That service will be provided by this RTA, that is Kfin. So number of corporate clients, it has been 31% up, and number of investor portfolio have been 32% up. This is year on year. So when we compare to last year, the number of clients, see in the 2024 March, it was 36% up. Again, in March, like every quarter, it has been growing by 35+%. Number of folios also 40% plus. and market capitalization also have been increasing. Now it's almost 50%. And here 944 clients added during Q4 and 1916 clients during FY25. So 7.8 million folios added during Q4 and 40 million during FY25. So new RTA mandates, that is registrar and transfer agent mandates, one during the quarter include different AMCs they have mentioned here, and main board IPO managed by Kfin is again 72% market share. So you can see how fast and aggressively Kfin is growing, even though CAMS is already there in the market. Here you can check the revenue growth, particularly through non-mutual fund revenue. Since I mentioned that CAMS is the one who holds more than 65% of mutual fund market, and KFIN is diversifying itself into other services apart from mutual fund. So the growth in non-mutual fund revenue of KFIN is, compared to like 2022, you can see the issuer solutions, it is 745, whereas now it is 1400. That means almost double. When you consider the international and other investor solutions, here it is 484 and now it is almost 3.5 times double. And global business services, it is 422, it has decreased comparatively. And total, when you compare total non-mutual fund revenue from 1600, it has come to 3 crores 307, that is almost double. And how does KFIN differ from CAMS? Because it is the one good company that is a peer company that is a very good competitor of KFIN. So inorganic growth, KFIN has acquired 5 companies till now to drive global expansion, including the Ascent and other companies. So strategic focus on SaaS. What is SaaS? It is software as a service. So strategic focus on software as a service, international clients, and fund admin tech. So it is growing with a diversified service. So key acquisition are acquired 51% of the Ascent,
और
then
आजकल गुजारा नहीं, तुमको बहुत पैसा दे फोन सा तो चल जाता है.
Okay. So access to 260 global clients since it acquired this Ascent company. So it has now access to 260 global clients and 576 funds. Regulatory licenses it got the regulatory licenses in Singapore, Hong Kong, UAE, Mauritius, and Gift City. So it's almost 2 billion annual revenue pool. It recently again acquired Hexagram, that is another SaaS platform for fund accounting and reconciliation. When we talk of SWOT, that is strength, weakness, opportunities, and threats, good thing is, if we consider from past 3 years, that is exactly 2.5 years, the growth has been, profit growth has been 78%, revenue growth has been almost 20%, then ROE is 27%, which is again healthy, ROC is 32%. And high Piotrowski score. What is Piotrowski score? It is almost, if you get together the 9 financial criteria like profitability, leverage, liquidity, operating efficiency, if we consider everything, this score is given between 1 to 9. And KFIN is the only company to have this score of 8. CAMS and I think CDSL have 7, but this is the only company to have the score of 8. And company is debt free, that is the debt is almost 0.03 now. When we consider of the opportunities, high FII stocks holding, like the company possesses high FII and DI holdings, mutual funds are increasing day by day and quarter by quarter. So this is the opportunity, means it is a never ending market for KFIN. Weakness is company is trading right now at the higher PE of 63, but it will come down in the coming quarter. And the company is trading at the high EBITDA of 41. Threats, if we consider, the one thing this company may face is fee renegotiation impact. fee renegotiation is like you're giving your service to a company, I mean the AMC, but AMC, since they have a good clientele and they are giving you the clients, you are doing the mediatory service. So they are telling, since we are giving you so much of business, please reduce the your service fee. So this is already in negotiation and all companies are coming together to do this. So this may impact. Government is also restricting RTA charges. So government is also thinking to restrict the RTA charges. That may impact, but if it impacts, impacts all the RTA companies, not just KFIN. And growth depends on transaction value. We saw last quarter what happened, because the market was down and people start withdrawing their SIPs, stop their mutual funds. There was a lot of withdrawal, and such behavior of the market will surely affect any kind of RTA, any RTA company. So that can be a threat. But thinking in terms of a long term, always it is a growing market. Here is the shareholding pattern of the promoters. In 2022, they had almost 50%. Now they have come to 32%, but it is not even 32%. No, exactly 1 month back, the General Atlantic Singapore, which had taken this company with 83% of share, now sold 1.7 crore of shares. So it comes to almost 10%. So in the next coming quarterly results, this may be reduced by 10%, but nothing to worry, because that has been again acquired by the DIS. That is, here is the sell, but there are 4 buys. That is, one among them is Kotak Mahindra also. So you may see the increase in DI holdings and decrease in promoter holding in the next quarterly result. Coming to the technicals, the interesting part is it had given its already ATH, that is all-time high, and from there it already corrected 50%, and again now it is up by 20%. So still you have a chance of investing, like 30% discount is there, and there's a beautiful cup and handle formation. Also along with this, there is a golden crossover, and there is a very strong support. So very likely the further there can be seen a uptrend rather than downtrend. And even if it doesn't follow the momentum or go uptrend, there will be consolidation. I mean, the market will be stagnant for a time, but surely this company is going to do well, and it may cross its all-time high very soon. And why invest in this company compared to CAMS? CAMS, it was listed in 2020. This was listed in 2022, or say 23 only. And since its listing, CAMS, almost for 2 years, there was a consolidation period. But KFIN, if you see, till date, that is in 2.5 years, almost it's a linear growth. Though 50% correction has been done, but if you see overall graph, there is a linear growth. And CAMS have given 44% since its listing, and KFIN has given 200% since its listing. And also the current price of CAMS is almost 4,000, and here it at a very good price of near to 1,200. And also you can see in both the cases, volumes are very good. Overall, it's not just about CAMS or KFIN now. Overall, like you have mutual fund increase 24%, other asset class up by 18%, equity up by 27%, monthly SIP inflow. You can just see that monthly SIP inflow, it has almost doubled. If you see SIPs here from 53 to 101, that is double. 86 to 164, that is equity, that is doubled. So overall, from March 22 to 25, if you see in 3 years, everything is doubled. So number of demat accounts is also up by 27%, and number of pension subscribers are also up by 12%. In no graph you are seeing any decrease in the any kind of service, that is, be it mutual fund, I mean, any kind of AMC's service. that is mutual fund, SIP, pension, folios, demat account, AIFs, nothing. So you are seeing a consistent growth in everything. And yes, when we compare to its strongest peer, your CAMS is more into mutual fund because it has a very strong hold on mutual fund, that is more than 65%, whereas KFin has almost 35%. Non-mutual fund business, here where the CAMS fails because it is only concentrating on mutual funds, whereas KFin has already it has a vast service apart from mutual funds and SIPs. Global presence, CAMS is very much restricted to India, and KFin is already expanding throughout the globe. If fee recognition negotiation is done, then this impact may be seen in FY26. But if it is seen, it will be reflected in both CAMS as well as KFin technology. And valuation wise, we go, it is 30 to 35, whereas KFin is 35 to 40 because it has many other services and it is a new company. Yeah. So before taking any queries, I would like to tell why should we go for this? I personally, why should I go for this? Since past 5 to 6 years, the SIPs have grown 7 to 8 times. That means investing into SIPs have grown 7 to 8 times in 5 to 6 years. It is never decreasing market. And when you compare KFin with any other, its peer, this one, current market price, it is a very affordable price. Competitors are very less because when you consider RTA, only two biggest RTA players come into picture, that is CAMS and KFin. KFin has a lot of diversification, CAMS is restricted, and expansion is global when it comes to KFin, and CAMS it is very much to India. And one good thing is, even assume that nobody is going to invest in mutual funds. Everybody wants to keep their money put into gold and anything. Only the normal SIPs that are there, even if they continue. So in coming years, AMCs will be triple. Leave about RTA. If AMCs grow, RTA will grow. So only if the money inflows only through the existing SIPs also, then also AMCs are going to triple. So this company and its service is never ending service. So we are likely to see an uptrend in coming days, and either it will go as a consolidation or uptrend, but never a decreasing stock. Thank you. Any queries?
Yeah, madam. This is Mr. Pramod.
Yes.
I'm audible.
Yes, yes.
Yeah. So, is there any correlation with respect to the operating profit margin with respect to the market? Say, when the market is up, they will say it is in a bull phase, then the operating margin increases. Or whenever the market is down, the margin comes down. Something like operating leverage and leverage in this business.
Mm-hmm. Like you're asking, I didn't get your question. Can you repeat?
Like you have went through the quarterly results also.
Yes.
For all these years, is there any correlation with how the market behaves? Say when the market is up, bull market, the margin increases, operating profit. When the market is down, the OPM comes down. Is there any correlation like that in this company?
Yes, definitely, because KFin is not restricting itself to any SIP or mutual fund. It is already if you're applying to your IPO, any dividend, anything, that any transaction between you and your company that you're investing, everywhere the RTA is involved. So if the market, it is directly proportionate to the market up and down.
Okay, thank you.
Yeah.
And mostly, I think it will be lagged by 1 quarter because of follow-ups, right? The market goes down and the SIPs or the other things may start going down in a quarter or so, right? It cannot happen immediately, right? If the market goes down today,
Yeah.
will people stop the SIP today? No. But if market keeps going down for the next 40 days, possibly the impact start coming. So direct correlation on that quarter may not be possible, but maybe 1 quarter lag should be there.
That's what we already reflected in the last quarter. The last quarter has been down.
Another question you have is why new people are not entering in this space if it is so lucrative?
The procedure to get the license to be a RTA itself is cumbersome. Like it's such a, I mean, a lot of things are involved to get a RTA license. So not many players right now into this, but there are many companies who are RTA, but their services are very limited.
Yeah, so one of the modes is the license basically. Even if you have the money, you cannot start the service tomorrow. So
No.
even if the new companies are wanting to get the space, but still they will take some time to reach to this level. People
Definitely.
are just not switching immediately. That's, I think.
Definitely, because there are like 10 plus RTAs, but not everybody is into all kind of service that Kfin is providing. And also the procedure to get the license of RTA itself is not easy.
Yes. So yeah, any other questions? Okay, what are the other areas they are targeting globally? And do we expect margin expansion out of this if they are targeting?
As mentioned, issuer solution, I said, AIF, I said, and SaaS. And if there are corporates, then very specifically, they're giving customized service also. This is not done by any other company.
Okay, great. So we'll stop it here. And any other questions, guys, please put in the chat and Rashmi will take it up from the chat or in the WhatsApp group.
Sure.
And we'll move to the next presentation by Shrikant.
Yeah. Thank you, Puneet. Thank you all.
Thank you. So you can stop sharing, Rashmiji, and to Shrikant.
Hi, everyone. Am I audible?
Yes, you are.
Thank you. Thanks, Puneet, for this opportunity to present in ALD. Stop my presentation. The company I'm talking about today is construction EPC player. Is the PowerMech Projects, and this is a engineering, construction, and procurement company. They are into end-to-end business of constructions of power plants and non-power plants. This company started in 1999 by first-time entrepreneur, first-generation entrepreneur named Kishore Babu Sajja. He has a 37 plus years of experience in this industry. Prior to this, he worked in a company called Indwell Constructions, which is also into a similar business, a small scale thing, but they were catering to the power sector, EPC constructions. He rose to the level of MD there, and then he started his own company, PowerMech Projects. And this company completes 25 years in this year. So the journey, if we see, they started in 1999 to 2006, 2007 phase. They were predominantly into the power plant constructions, and it's a local player, headquarters in Hyderabad. They were predominantly doing the EPC power plants, thermal related things in Andhra Pradesh at that point of time. From 2007 to 2014, they went nationwide and acquired several orders from across the country. But still, they were into the power sector only at that time. They also started the operations and maintenance part of the business. From 2015, this company came as an IPO. And from there, they have diversified and became a overall construction company. They entered into a non-power segments like roads, railways, water, and other areas as well into that. So from 2015 to 2020, 21, they were into complete construction of it. And then they entered into the mining operations in 22. That is the breakthrough. So mining development and operations is what they have acquired 2 projects in 22, end of 22, 23. So from there, the new entrant has come into their journey. So you can see the power sector, how they have. So in power sector, what they do is the ETC, erection, commission, and testing of the power plant. It is an end-to-end construction of the power plants, be it a thermal power plant, gas, hydro power plants. They do all that, and they also into the operation and maintenance of the thermal power plants. They entered into the second phase. They entered into a civil works and non-power plants on this, and then the roads, water, mining things. Company has completed 208 projects so far on the date, 80 plus clients, 25 years of experience, 40,000 plus manpower, around 13,000 on payroll. Others are contractors. The company overview, if you see, this is a complete power infrastructure company. They have around 165 projects ongoing, 15 overseas projects, and 58 AMC projects. This is the largest O&M operations and maintenance service provider on the private side. They have a significant order book from the IPO of 3,500 crores to around 54,000 crores now. And this is the largest provider of O&M services, backward and forward integration. When I say backward forward integration, the power plants will have the main power plant as well as the ancillary part of it. And from the engineering, from the design part to the construction, then the maintenance, all this is taken care by the PowerMech. So that in that sense, it is a forward and backward integration of it. And then they entered into the industrial plants and railways, metros, roads, water, mining sectors. Consistent track record of the growth with stable margins. Company has maintained around 11 to 13% of margin for the last 7 to 8 years, and PAT margins of around 5.5 to 6 to 6.5%. Company has a presence apart from India. They are into Middle East and Asia, and they are aspiring to enter into the new geographies like Uganda, Sudan, Kenya, Qatar, Iraq. Long-term relationship with market clients. So client list: BHEL, Coal India, Jindal Power, Siemens, Adani, Vedanta. You can see all those things. And they also work with a JV partnership with RITES, FL Smith, and RVNL. Company has a 13,000 around manpower as of now. This is Q4. In the con call, they said 13,000. So they are recruiting people as well. So they are growing in that sense. The company, when we look at the product views, company predominantly into the industrial construction, the erection, testing, and commission of the power plants is the main core business. That is where they started. Then they ventured into the refineries, petrochemicals, oil and gas, steel and minerals. New entrant is the nuclear power plant constructions. Okay. They cater to the coal-based power plants, BTG and BOP. BTG is the boiler, turbine, and generation of the power. And then the BOP is the ancillary part of the power plant. So BTG is the heart of the power plant, and BOP is the ancillary part of it. And they have the capabilities to build ranging between 150 megawatts to 800 megawatts, including the FGD and SCRs. FGD is the fuel gas desulfurization. So this is a kind of environmental norms. The gas emissions from the power plants has to be less toxic and less carbon, green gases. So that's the FGD part of it. The other vertical of the business is the industrial services, where the operations and maintenance. So they maintain all those power plants, be it a boiler repairs or the turbine, fins changes and other things. And also they are entering into the O&M of the other than power sector as well. They are aspiring to it. This is a very interesting business from the PowerMech segments or segment wise. They are also into the constructions. This is a normal civil constructions. It could be building constructions. They are into railway electrification and broadening railway line constructions. Also, they are into the metro. Say Chennai and Bangalore metro. They have the metro depot constructions they have done, and fabrication works they do for the industries. The other important business from them is the mining part, which is the coke coal mining. They have got two contracts in the last 2 years, which are massive in the number. We will go through that in the later slides. This is a new entrant into the business. So they have around 4 to 5 verticals. The two important verticals which are giving a leverage now is the operation and maintenance and the mining part. So operations and maintenance part, if you see, they have fully developed into the thermal, gas and hydropower. They are catering to around 41 power plants, thermal power plants, and others are non-thermal power plants for AMC. And they also have an export in the AMC. I think it is in Nigeria. Okay, and they have partially developed that in refineries and petrochemicals, steel, electrical network. So first they start with construction of that, then they will get into the AMC of that. So that's how they are growing the business over a period of time so far. Okay, they are aspiring for the water projects and mining and cross-country pipelines. The revenue, if you see, it has a CAGR of 20% or 19 to 25, which is a very good thing. The best part of the operating operating and maintenance is it's an asset-light thing. Normally, all these construction companies will be asset-heavy, where you have to buy a lot of equipment and then do the constructions. These are asset-light, where 30 to 40% of the cost of O&M is coming from the, that is the employee cost. So 15 to 20% is the spare parts and others. Okay. So, and this is a high growth potential business with a high margins. Margins could be around 17 to 80%, 18%. These are long-term contracts, usually 3 to 5 years contracts. Generally, the EPC contracts would be around 1 to 3 years or maximum to 4 years. But this is on a higher side, 3 to 5 years. So it gives more revenue visibility in terms of that. Okay. And they are aspiring to get into the other businesses of AMC as well. So it could be a growing potential for the company. Coming to the other thing, the mining development operations. So this company has 2 major orders. One is from the Coal India for 9,300 crores, which is executable over next 25 years. And the other order is the SAIL. It is a 30,400 crore order, which is executable over 28 years. So what the company is going to do for this is they have to acquire the land. First they bid and they won these orders, and they acquire the land of that place, and earth moving overburden with removal. Then they will set up a coal handling plant and a washery plant. This is like a coal handling plant is you extract the coal and put it into the plant, do the processing of it. The washery is like a cleaning of the coal so that impurities, ashes will be removed, and then any moisture will be taken out. So it should be a moisture free for the coal to become a coking coal. So coking coal that goes into a crushing and screening machines and then large fleets, and it goes to these companies. So SAIL has given this because SAIL for steel production, coking coal is the basic raw material for them. Okay, so this is very important for them. That's why the deal came from the SAIL for this. And yeah, and also they are aspiring for the O&M contracts from the same mining developments. So this particular segment is very interesting because it is a very long duration contracts, 25 to 28 years. So stable revenues are expected from this. And this is a coking coal. This is a processed coal. The margins are on a higher side, like 23 to 25%, the highest margin segment for this company. Okay, and these are the big orders, and they are in JV with PC Patel and AMR for 74% to 26% ratios. Okay, and just taking a step back to understand what is the industry and how is the TAM for this industry. If you look at the power sector, power EPCs, they can be divided into three sections: thermal EPC, renewables, and transmission and distribution. PowerMech is present in the thermal EPC, competing with L&T, Sterlite Power, and Tata Projects. They are not into the renewables, they are not aspiring for that. And on the transmission side, they have competition with L&T, KEC, Transrail, NCC, Kalpataru Projects, Ashoka Buildcon, etc. So looking at the TAM for this, the EPC segment is expected to be around 1,30,000 crores TAM, and PowerMech has a backlog of around 12,000 crores. So it roughly 10 to 12% of market share for them. On the O&M side, operation maintenance side, 3.5 to 4.5 lakh crores is the market. They are currently have a 3,000 crores of backlog order book, which is roughly just 0.1% to 0.3%. But they are from thermal private O&M point of view, they are a major player with 3.5 to 5.5% of market share. So this gives us the visibility that how much possibility is there for a company to grow. Though there's a intense competition, everybody will have their own share of pie. PowerMech is among the top 3 players, private players in India, outsourcing for the thermal O&M. Strong presence in the large utility projects like NTPC, JSW, Vedanta, and they are increasing high recurring margins in this businesses. Coming to non-power sector, other infrastructure, if you see roads, railways and roads, around 6,000 to 6.5 lakh crores is the TAM, and PowerMech has 2.5 to 3,000 crores of order book, which is 0.5%. Water and sewage, 4 lakh crores. Their presence is just 2,000 crores. And oil and gas, 1 to 1.5 lakh crores, 500 crores is the order book as of now. Fabrications is around 100,000 crores. 600 crores is what they have a presence. So roughly 0.5 to 0.7 is their presence in the overall. In certain areas, they are aspiring in the non-power sector. And this growth in the non-power sector is mostly backed by the national infrastructure projects, Gati Shakti Yojana and Jal Jeevan Mission. Okay. And by segment, if we see the market position, how PowerMech is placed, railway and metros, they are a growing player. Water infrastructure, they are emerging strong EPC. They have UP Jal Jeevan Mission, 2,700 crores or something. They are aspiring for the other southern parts of the country. And roads and pipelines, limited order book for them. They are not too aspiring in that. Mining, they are fast scaling in that. Okay. Coming to business strategy, how they wanted to grow as a strategic thing. They wanted a full forward integration of the core businesses, and they wanted to identify them into the infrastructure infra segments like railways, water projects, roads, more deeper into that. And they have tie-up with others in terms of the fuel gas desulfurization retrofit. This is the green initiative I was talking about. As of now, they have the order from Adani, which is on hold. But this is something when environment norms comes back, these projects, these kind of projects might be coming to PowerMech. Enhancing the execution capabilities, they're aspiring for that, expanding the O&M profile to all the non-power sector and entering into a value-added services. So far, their margin profile or the business is on the construction side, where the margins are limited. And now they are entering into a value-added products and annuity-based things, where the transition will give them higher margins, more value-added products. So that becomes a mode for the company going forward, probably. And they're also taking some digital initiatives, not mentioned complete detail of it, but yeah. And they are aspiring for for around 15 million tons per annum production of the mining thing. As of now, these two coal plants maximum utilization capacity on 3.5 to 3.5, so 7 million tons per annum. Okay, they are aspiring for double that in the going future. So all this, they are banking on the national infrastructure pipeline, which is 111 crores estimation for the. Coming to the clients for this company, you can see NTPC, BHEL, Siemens, all these domestic clients, and these are the international clients. Some of the domestic clients you will also see in the international: BHEL, Engineers India, L&T Power. So these PowerMech becomes a subcontractor for them in international projects. So that shows the trust they have on the PowerMech. Coming to the management, board of directors, Kishore Babu is the founder of this company. He holds the CMD. His wife is into the HR and the CSR activities. Two independent directors, 40+ years of experience. One of them is Suzlon CEO, JP Chalsani, and one non-executive director from BHEL, 38 years of experience. And Rohit is Kishore Babu's son. He's into the business, so second generation into business. He's currently overseeing the, he's handling the overseas operations and then the business strategy, digital front, other stuff. If you see the other members of this board, they are all vast experience, like 25 to 40 years of experience, predominantly in the core power sector and infrastructure related. So say this company is managed by a good professional people, backed by a good promoter. They have a clean sheet. They have no issues so far in the corporate governance. Very good, well-managed company in that sense. Coming to the order book, this is the order book they have from 19 to 25. You can see that they have grown from 2,700 crores to around 6,000 crores. Two outliers is the 22 and 24, where the MDO projects, if you take them out, it is a good growth path. There's no spikes on it. Yeah, in 25, they aspired for around 10,000 crores of order book, but due to the elections and less spent by the government on the infrastructure, their order book was 6,500. This is one area where there's a threat, I would say. There's a problem can come if the orders does not come in time. Okay. Looking at the order book backlog, it's around 8,500 crores from the civil water rail. O&M is 2,700 crores. Mechanical 6,500. Electrical around 900 crores. FGD is the Adani one, which is 4,300 crores. This is the non-executable as of now. They have excluded from the executable order book. The thing is, this FGD is the environmental norm. The Ministry of Environment and Forest has extended the timelines for the execution of this. So Adani is taking lenient on it and then diverting their capital to other places. But this is not out of the order book as of now. This is not cancelled. This is just deferred. It could come back any point of time once the announcements on the execution dates finalizes. If you see this client concentration, Adani, this 4,200, if you take out, that's around 700 crores on the civil and mechanical side. Vedanta, O&M around 1,100 crores. And NPCIL this is the nuclear EPC. They got the first nuclear plant, this one. And the BHEL, they have a long association with BHEL and NTPC L&T. So they get the subcontract from BHEL and also from L&T. They are also a competitor for BHEL and L&T in terms of bidding. So they have that kind of a relationship with them. Okay. And then the SAIL and Coal India, these are the two mining projects. And UP Jal Jeevan Mission around 2,700 crores. The execution is done, most of it, but the payments are pending for this because last year and they did not get the payment due to the end of the year, and then as per the con call, the funds have been diverted to the Kumbh Mela, and then it is taking time for the receivables come in. So 415 crores of receivables is pending from that section. But there is one O&M contract from Nigeria here, you can see. And coming to the financials, the revenue mix, if you see, the civil works has a growth from 800 crores to 2,400 crores of revenue. And then erection works, more or less, it is in the same level. But the O&M has a 566, has become 1,700. If you see from last year to this year jump, 1,100 to 1,700, a massive jump in that. And M&O, if you see this 44 and 84, these are the mining operations. They started contributing slowly to the revenue now. Usually these mining contracts are long-term contracts. So first 2 years will go in terms of the preparation, cleaning of the overburdens, and then the mine readiness for the coal production. The coal production peak is expected in FY27. Okay. Till then, it will be a blended combination of revenues coming from the mining. And that is where the capex is also happening. We will see it later. So coming to the product mix, revenue mix by product, if you see 22% has gone to 46%, and O&M is stable at around 33%. EBITDA margins, this is a peak of EBITDA margins for them around 13.4. Now they are 12.3. Okay. If you see the PAT margin and steadily growing from 11% to 12.3, and it must be growing in the near future. If you see the PAT margins in consolidation, then 13 point, when peak 13.4, it is 5.3. Now at 12.3 EBITDA margins, it is giving a 6.2 PAT. So which is, that means debt is managed beautifully. Coming to the financial statements, is just to give you a view that revenues, how they increased from 1.5 to 5.2, 5,200 crores. And the margins, how it is like 13.4 is the peak margin of 18 and 19. And PAT at that time it is 5.1, now it is 6.2. Okay. Company has plant and equipment has increased. Mainly they have purchased some plant and equipment for the mining operations, which is good. And if you see the receivables, trade receivables increase. This is the Jal Jeevan Mission receivable pending, which has impacted the debtor days and the working capital days. So some amount of pressure on the working capital because of that. Share capital, if you see 16 became 32, two things. One, they did a QIP as well as a bonus 1:1 share in the last year. So that is the reason for increase in the share capital. And borrowings increased to the same extent, and trade payables also slightly up. Coming to return ratios, ROE is around 16%, ROC is around 22%, 23%. Debt to equity ratio is around 0.34, which is good. Based on their con call, if I project the revenues. Revenues they said around 6,500 to 7,000 crores for 26 and 8,500 crores for 27. I've taken a conservative approach around 6,500 crores by segment. Okay. If you see the EBITDA margins like 11 to 11.5 and 12%, it is increasing. And only the electrical, they are decreasing consciously, they are reducing their share. Okay. Mining, if you see, it is 84 as of now contributing. It is expected to 400 in the next year and then 1,900 crores in 27, which is a peak. Okay, from then onwards, I think 1,900 should be a recurring revenue for the mining part. Okay. So if you see the EBITDA margins, 12.3% is increasing to 30.5 to 14%, as well as the PAT margins from 6.2 to 7.5. CapEx, if you see CapEx, they have done a 240 crores of QIP this year, mostly for the MDO infra and other infra. And next year they're planning for 500 crores, mostly for the washery plant construction for the mining and other infra projects as well. 150 crores they are planning for the debt next year. They have no plans of equity dilution next year. Expected 27 is around 250 to 300 crores. Coming to the technicals, the charts has formed a beautiful reverse head and shoulder here. I think this is the result time for this Q4. Result was good, and then stock has inched up, but it has a very good support around 2,850. Good time to accumulate if you're interested. Looking at the SWOT analysis, strength, diversified revenue streams, robust order book on 57,000 crores, 5 years of visibility in revenues, annuity like cash flows and MDO and O&M. Execution capabilities, 25 years of experience in thermal, industrial, infra projects, and high margin O&M and MDO focus. This is what very lucrative as of now. O&M margins are expected to be north of 17%, and MDO margins are expected to be around 18 to 25, but stabilizes around 23 to 25 is what management said over a longer period of time. Strong management team, stable, experienced promoter group, board with governance and history, clean audit reports. Coming to weaknesses, working capital intensity. This is a construction company, so a lot of capital requirement, and then working capital requirement will be there. There could be now net working capital cycle, if you see 130 days, it is a higher side. Dependence on the government contracts, most of them directly or indirectly related to the government spend and the contracts and and 60 to 70% of the contracts coming from the PSU and state projects. So tender finalization, bill approval, payment dispersal could be an issue in that area. Revenue concentration, they have a revenue concentration, 4 to 5 clients. Revenue concentration risk is there, but all those clients are very marquee clients, and they have a very long relationship with them. And O&M contracts will give that visibility, so should not be a big weakness or big concern. Slow monetization of arbitration awards. They have an arbitration issue. I mean, they have an issue and went to court for settlements, and around 142 crores of arbitration they have won, but it has not monetized fully. But this is not a recent one, an old one. Opportunities, if you see, India infra capex push is the major opportunity, and then energy transition and green energy. Companies aspiring to get into a green hydrogen power plant construction kind of thing, and desalination power plants, they said. They also mentioned about the battery energies, BESS, battery energy systems. Okay. And export market expansion. They are planning to get into another 6 to 8 countries in Africa. high O&M renewal rate. Threats are the delays from the client. Payment delays could be there, intense competition in the EPC business. We have to compete with giants like L&T and BHEL, KEC. And margins may compress in the civil EPC. That is why they are entering into this O&M and the MDO, where they get more margins. Okay, execution risk of the MDO project. Yeah, this risk could be there. Land acquisition problems could be there, and slippages or anything is there that could be a threat. Interest rate and commodity volatility could be a problem, but they are all priced into the contracts. My escalation clauses will be there. On top of it, if something happens, that could hit company's margins. That's it from my end. Any questions?
Great, Shrikant. So first time for you. Thanks for taking your hand up and bringing to us a wonderful company.
Thank you.
Any questions, audience? From my side, one question I have is, for example, companies trying to possibly say that they're trying to increase the margins basically with integration also. But do you really think it will improve from this angle? Because it's just a kind of a operation and maintenance business, right, in the longer run.
But the thermal power O&M players are very limited, Puneet. You have Thermax and then the PowerMech, two major players in that. So in that core area, the new entrant may not be there, but in others, yeah, there could be possibility.
Okay. Okay, one question we have in the chat is, what is the capacity they are building for green hydrogen and the revenue they're expecting?
That is in a very nascent stage as of now. They have not given any projection in terms of green hydrogen thing.
Okay. Okay, thank you, Shrikant. You can just see the chat, maybe some question if I missed. And audience, if any more questions you have, please ask in the chat. We will take from there and we'll move to the next presentation by Amar. Thank you, Shrikant. Hi, Amar.
Hello.
Yeah, hi, Shrikant. You can drop off basically, and we'll move to the Amar.
You can see my screen, Puneet.
Yes.
Okay. So let me start by directly jumping into it. The stock that I have picked this time is Shaily Engineering. For people who attended ALD4, I had already hinted at Shaily Engineering is the one which I'm looking at, and that is because of the whole tsunami factor which is coming from the GLP-1 ecosystem, right? It's the projected growth is tremendous. Many innovators as well as generics and the whole ecosystem is into it. And Shaily Engineering kind of fits into that GLP-1 portfolio, how I will speak about in the further slides. So before that, let's talk about Shaily Engineering at a very macro level, top view level. Shaily has almost like 4 decades into existence now. So 38-year-old company, and they have survived. And in the later stages, when we look at it for the past 2-3 years, they are kind of flourishing. So when initially they started out, they are more into precision engineering. So when I say precision engineering, why do I say that? Because they kind of like get into devices which are very small, intricate, but at the same time, has a tremendous value to the life system, as well as like, since it is pharma related drug delivery and the dosage control, they have to be very precise as to what's happening, how much kind of dosage we are giving, and in what quantity, and how do they go about it. So that is where their forte is, and that is where their whole existence started out with. In the initial stages of their existence as a listed company, the perception was it is more into a commoditized business, because like they were making pens and injectors for insulins, which is for diabetes control. So this was it was a mass volume game, and the profitability came from the scalability and the margin of scale, right? How they are scaling up and all. So that is why they didn't get the value initially, but of late, like things are changing. And that is one thing which we have to keep in note, because the first reaction when we look at the financials and the financial ratios of Shaily, optically it looks very expensive, and it is expensive. Like when we talk about P of 80 plus and all, I will cover all those points going forward. But then we have to look at like where Shaily is today and where we are pursuing it to be 2-3 years down the line. They are transforming from a mass commoditized business to high margin, very niche areas, and there they are coming out as a differentiator, not only in India. In national level, I think Shaily is the only company of its kind in India. But globally also, when we talk about competitors, there are like very few which we can count on our fingers, less than 10. So that is where their journey is proceeding towards, and that is what we have to, that variant perception we have to keep in mind, that the business is transforming, the margins are going to increase, and depending on the execution, the value of the pie share which they are going to get can be huge. The runway is huge, and based on that, we have to have a relook at Shaily and then look at our thesis and see how things go about it. So having said that, if you look at like the fourth line within the screen also, I deliberately put it over here. Shaily has the ability to manufacture plastic components weighing as low as 0.03 grams and with tolerance of 5 microns. When we talking about 5 microns, it means to that level, it means not even millimeters, we are going one level deeper. So that level of control they have, and that is why I said it's more of a precision engineering company. Why does this bode well for Shaily? Because since they are master in that and they have like those kind of controls over there are many industries which has come up as an opportunity for Shaily. 3 business segments I have already listed, and I'll talk about it in a while, just a while now. So 3 major business segment which currently it is in. One is consumer, the other is industrial, and then the third one is healthcare. The fourth one where they are trying to get their feet into and get their foray into is consumer electronics. So what do we mean by consumer electronics? So any kind of, like, see, we talk about say laptops or mobiles and those kind of things. There are many plastic components over there, and we need high performance plastic components over there, which are very minute, because scaling down the devices, that is the norm. The more thinner, the more micro, the larger the power of influencing for consumers to buy it, right? So when we are miniaturizing the whole electronic system, that is where Shaily will come into play. They are already into advanced stages of the 4th segment which they are trying to carve out, which is the consumer electronics. I think they are talking with 4 different companies over there. But even though it is at an advanced stage of talk, when we look at the con call and the management commentary, they are not willing to commit per se, like who are the companies or business they are talking to, what kind of revenue it will be, because as per them, it is still in the nascent stage, it is still in the discussion. But in some places, they are kind of like giving proof of concepts and all. So that is the 4th business segment which we have to look out for. Right now, it is non-existent, but when it comes through, it will commit in a big way. Having said that, let's look at the current 3 segments. So we have consumer segment, which is the biggest revenue contributor to Shaily currently. So almost like 70 to 75% of revenues are coming from the consumer segment. Within that, like there will be different further subdivision they are which is contributing to the top line, bottom line. So they are into toys, they are into LED lights, FMCG packaging, home furnishing is a big one, and IKEA is one of their bigger clients, which is kind of, there is a, in a way, if you look at it, IKEA almost is 55% of their business within the consumer segment. So that becomes a client risk there, but they are trying to diversify into various other segments, and within the consumer segment also, they are in talks with other clients to build up their business so that one client reliance kind of like comes down. I have last mentioned carbon steel furniture. Specifically, I mentioned that because they are seeing very good traction over there, and management commentary is that within 1 or 2 years, that carbon steel furniture itself, just as a sub vertical, it can contribute almost 120 crores. So Q4 FY25 full look at it, the revenues were 787. So if we say like 800 crores was the revenue on 120 crores is what carbon steel furniture can scale up to, that is almost like more than 10%. So that becomes a that is the one which is contributing to the growth. Consumer, if we look at it year on year, it has been growing at 17%. Industrial, it has been going around 12%. Within industrial also, there are certain differentiator which only Shaily has. I'll speak about it in further slides. But the growth is 12%, and the biggest game changer for them is the healthcare vertical. Because if you look at the growth, it is currently 53%, and if the look at the previous quarter, it was almost 57 to 60%. So healthcare is the one which is the game changer right now, and that will also get reflected in the revenues and the way they are scaling up on the margin front too. So we will address this more in detail in further style, but at an overview, this is where we are. This is what Shaily Engineering is all about. Established in 1987, started with 2 molding machines. Now they have more than 210 injection molding machines, 2000 plus employees, and they have 7 plants. They are mostly located in Gujarat, like all the plants within the Gujarat area itself. But then export, like if you look at it, they are exporting to about 40 plus countries, and almost export itself is contributing 75% of the revenues today. So within India, domestically, they are getting 25, around approximately 25% of the revenues. That's just from the exports. On the right hand side, there are like certain certifications which I have mentioned. So compliance and standard wise, like they are fully compatible, and at the same time, they have a very high respect in the industry, where clients, when they come to Shaily, they start as a pilot, and once they are with Shaily, they kind of remain with Shaily. Why do I say that? In Shaily's whole 38 years of existence, they have not lost a single client. All the clients which have come into its fold have continued with it, and the business is flourishing from that perspective. All that points is to the quality controls and the security features which they have uh, entrenched within their process and systems. So that bodes very well for Shaily, and it speaks highly of the processes they have put it in place. I'll move on to the next slide. So this was the overview where we are going into. This is just a look at the preceding quarter, like I said, and part of the peak I have already given, where we talked about like the 3 business segment, how they are contributing. So total revenue, we are looking at 787 crores, and that is how it is going. So why we are talking about Shaily today, and why did I say that from a mass commodity manufacturer where it was not getting the valuation? What are the things which are changing? The game changer is GLP-1. GLP-1 is apart from Shaily itself, overall, if we look at it, pharma as a sector, and globally, this is a global phenomena where everybody is now kind of like focusing on the GLP-1, and it is scaling very nicely for the innovators as of today. Novo Nordisk is the one which has come out with semaglutide, and within that, it has come with Wegovy and Ozempic for diabetes as well as weight control. They are doing phenomenal business, and they are kind of like taking all the market share because of the lock-in period, right? Having said that, rest of the world, 2026 is the time when many of the patents expire, and that is where the generics player will come into play. And when the generics player come into play, Shaily will benefit from both, right? They will benefit from innovators as well as generics player. So innovators can jump onto the Shaily platform as well as the players will latch on to Shaily because it becomes more scalable for them and at a reduced cost. So that becomes very optimized thing for them. So within the GLP-1 ecosystem, if I look at it, this is the one which I have circled. We are focusing today now on the device injectables. Like I said, ALD4, I had kind of like again referred to this slide. And there we had focused on the innovator generics part, and Natco was the company which we are focusing on. So today we are focusing more on the devices, injectables, how it is coming. And one comment I had made in my last presentation also, GLP-1, suppose like when we talk about the drug yet, because of the long runway, when we talk from a patent perspective, if it is like say X patents which are going with the whole molecule itself within the GLP-1 ecosystem, the device, the injectables, the OEMs of the auto injectors and the pen injectors, they are having almost 3x to 4x patent on the delivery device itself. How do they do? Why so much patent on a device which we think is okay, run of the mill? It's an ancillary kind of to the molecule, because the way the drug is being delivered. See, how do we talk about it? Like a drug delivery, when we talk about it, it has to go in a precise formulation and in a precise dosage. And it should be kind of simple enough where the person, which is the end consumer, which is like person who is going to take that drug, it should be simple enough for them to not screw up and kind of take that, right? So that is where the complexity of the design and the integratedness comes into it. And that is why there are so many patents which are involved in it. So if you are talking about 3x, 4x patents on the device itself, it's very easy for one OEM manufacturer to kind of like step onto other shoes. And that is where the patent infringement might come into play. But that is where the 38 years experience of Shaily comes into play, because they have been into this creation of the injectors for the past 4 decades. And over a period of time, they have their own plethora of like patents, which has protected their design and all. And they have got a head start, wherein globally, if we look at the delivery system for the injectors, they already have 85% of the patent on their side. So they are not infringing on other suits. And that is why they become a very viable alternative for companies, not only in India, but from global perspective also. Any innovator which is coming into, they will look at Shaily from that perspective. Okay, this is what we need, and they kind of drive the specs and get the device from Shaily once it is finalized, and that it has a longevity also, in the sense once the innovator or the generic manufacturer comes onto the Shaily platform, it gets kind of locked in. It becomes a mode kind of, and usually once the client comes in, it will not go out, because they have built up a brand on that device from that perspective, and that brand is kind of tied up. The output is being provided by Shaily itself. So this device injectable is what we are focusing on. GLP-1 is the opportunity. This is where the whole thesis lies. So when we talk about GLP-1, I'm talking about the peers now for Shaily, and this is more from a device manufacturing perspective only, right? So we have three major peers. Ipsomed is there, which is a Swiss company. Its turnover itself is like 600 million, approximately $600 million. Then the second big one is the USA company Becton Dickinson. And then there is HL Medical. SHL Medical is a private entity. It is not a listed company. It is from Taiwan. So relatively, if you look at the scale, it is doing approximately 110 million business. And this is where SHL Medical will be more kind of like one-to-one comparison with Shaily in terms of the scale and all. Scale is something which Shaily has had to prove. When I say scale, currently, as of today, Shaily is manufacturing almost like around 5 crores of injectors, more on the insulin side for the diabetes and all. They are ramping up that capacity to double the capacity, and it will almost go on to become 10 crores and all. But when we look at Ipsomed, Becton, they are already like much ahead of that. And they have already proved that they are the ones who will be giving the scale. So Ipsomed is the one which the innovator Novo Nordisk has kind of latched onto. They go hand in hand. So all the Novo Nordisk globally, the injections and the injectors as well as the pen injectors, they are being manufactured by Ipsomed. And if you even look at the way they are planning to expand, they are planning to do the capacity expansion by 4x. And for that, they have planned out $1.2 billion investment. So this is where things are going, and everyone is pursuing. Some of this has already been realized from the innovator perspective, because for the past 2-3 years, Novo Nordisk is kind of ruling the weight control drugs over there because of the semaglutide, Ozempic. But now there are other things also coming into play. There is another innovator called Eli Lilly, which is a USA based company. They have got a different alternate formulation that is coming out very good, and they have come big way in India because they are in a innovator. They are not kind of like tied up with any lock-in period or like wait for the patent to expire and all, because they are the one who hold the patent. So they are getting good traction in India also. So very roughly speaking, these are the three peers which we should be comparing Shaily with. Within India, there is no direct peer per se. So before we move forward in the sense ki aage kya hoga, we have to look at have a look at the past and see ki in the past what has been done. So we are looking at this around 5-6 years of period and see what is the capex which has been already been done by Shaily, what is the utilization and where the money is going into. Most of them, if you look at it, second last row, it is into PPE, which is property, plant and equipment. This is the tangible assets like which are being built into. So if you look at it in the past 5 years of period, they have almost spent 537 crores, and the capacity has been, it is in metric ton because this is the consumption of the polymers which we are looking at. Like polymer is nothing but like they are into like enhanced plastic and all, right? That so that is the input raw materials, and that is how they can process. This is where the capacity is being growing into, and this capacity is being more triggered. The capacity expansion is more triggered. First of all, many of the global peers and all, which are peers of Shaily, they are kind of like vacating that insulin space because, like I said, it has become a kind of a commoditized market, and on top of that. There is a very heavy pricing sensitivity there. So it is not that we can insulin ka injector bana rahe hai, so if my 2-3 competitors kind of vacate the space, I get monopoly and I can have control over the pricing. No, it has now been in the entrenched in the market for so long that the end customer has become sensitive to the price. So there is only a certain amount of expansion which you can do from a price perspective. So price sensitiveness will be there. So at times it might become unviable for people to kind of like focus there, especially when I look at it, there is another opportunity which has come on right now, which is the GLP-1, where the margins are much higher. And that is where the global trend is. Many of the OEMs, they are kind of migrating towards OEM and they are kind of like taking their eyes off the from the insulin market. Shaily management, if you look at the last two con calls, they are saying that they are still committed to the insulins. But Q4 FY25, if we read the con call, Jan to March wala con call, if you look at it, they are very clearly said that they are not going to vacate the insulin market, but at the same time, they are kind of trying to pick and choose the clients now. They are not going to cater to everyone. They are only going to look for clients who can provide the scale, who can provide the volume commitment and the capacity commitment. So one advantage is like it is already an entrenched market where Shaily has proved themselves. The revenues are there, it will come like an annuity. At the same time, when they pick and choose, so they are not going into certain contracts where the scale is not there and they cannot earn money or it will impact their margin. So that kind of differentiation is creeping into. But insulin market is the one which Shaily is still focusing on. But at the same time, because the trend is there and because the business is there, they are also kind of readying themselves for the GLP-1 expansion. From Shaily's perspective, when we look at the rest of the world and India, 2026 is the time when the patent for the innovators expire, and that is where the real game will start from. So we are still 6 months away from actual things going live into production and the revenues flowing from that perspective. But since it is only 6 months, they also have to scale up and have the capex ready so that when the order actually arrives, they are ready for that. Why I'm saying that is because like for the past 5 months, like I said, 537 crores they have already spent. This is in the past. Going forward in the next 3 years, they are proposing another 500 crore plus capex plan, of which almost 150 crore is specifically for the healthcare vertical. But then the good thing is for the Shaily, all the three business segments, they are growing. So consumer sector as well as industrial sector, both are going to get the part of the pie of the new capex. And like I said, there is a fourth business segment which is being kind of like being talked about in Husserstone because right now there is nothing tangible or concrete on the ground to see. But consumer electronics, again, it can become a vast growth area. But till the time we actually see the execution and the management start commenting directly on that, we will have to just give it a patient year. But part of that 500 crore expansion in the next 3 years, it is also going to be, one pie is going to go to the upcoming that consumer electronics sector also. Moving on to the next slide. Here I have kind of projected ki growth runway. When you see this FY25, I have put that in yellow because that kind of differentiates, because anything on the left, it has been already executed and that results we have seen. So this is where on the left hand side and including the shaded yellow part, like that has already happened. This is not estimation. This is what has actually happened. And to the right of the one is where we are giving estimation. And when we are taking the estimation, we have kind of like provided a bit conservative. Why do I say conservative? For example, if I look at it, net sales 23, 24, 25, if we look at it, went from 6,000 to 6,500 and almost 8,000 here. And with growth percentage wise, if we look at it, FY25 was phenomenal, where overall growth came from 22.2% at the consolidated level. And the biggest growth vertical was the healthcare vertical because it grew almost like 57%. So that contributed to pull it up from. And this also shows like where I made that initial comment that Shaily was pursued more as a OEM in a commodity market, जहाँ पे we know, okay, धंधा तो है, they will do that kind of business and they will do the annuity जैसा इतना इतना पैसा आएगा. But there was no, how do I put it, asymmetrical expansion and asymmetrical returns. There was no probability of that. That push is being provided by the GLP-1. Still 6 months away, still kind of like uncertain because many things are projection. But when we look at the dots and try to join the dots, the story which is emerging is a very persuasive one. And that is what we have to follow. So if we look at the shaded part itself, sales growth is 22.2%. Margin, you look at it like growth margins are there. It was 15, 18 teens में आ रहा था. Now it has come to 22. And this 22 is what we are trying to carry over. And GLP-1, once it materializes, we are not getting very aggressive. 22 का we are, in 3 years, we are just saying कि 25 तक तो margin हो जाएगा, which is very feasible. With these numbers, if we look at it, for example, just look at FY28 and suppose like my EPS today, it is 20.3. And with this growth factor, if we say that 3 years down the line, it becomes 52 and my current P is 80, वो भी उसको भी मैं अगर कुछ नहीं करता हूँ, just from the 80 perspective and the 52 वाला EPS में लेके जाऊंगा, the stock price projection will cross like more, will be more in the 4,000, 4,500 range. Today it is at 1,750 kind of thing. So we are saying ki that is what is feasible. This will be a high growth runway which Shaily is going to take into. So it will always have a high P. There are no two thoughts about it. But the high growth, if it materializes and we are just taking a conservative estimate and growth में हमने बोला है कि it will just be 22% and 20 over a 3 period it will be like 26%. Rule of 72 से भी देखेंगे तो 25% अगर मैं ले रहा हूँ और 72 बोल रहा हूँ, तो in that 2.5 to 3 years it has to double, right? This is where the projection is coming into play. But let me reiterate that anything which is on the right hand side of this yellow shaded line and before are actuals, what has happened, what the company has given the results. It is book profit kind of thing. The rest of the things are estimates. Estimates can like, they can go wrong because there are so many moving factors. But when we look at the past and kind of try to join the right, this is what the scenario is emerging. That is all I'm trying to highlight. So this is where we are. I'll move on to the next slide. So let's talk about growth triggers and when we are going to give that high, because today, frankly, optically, if we look at it, ATP hoga to, then we are saying that it's a very expensive valuation. But is that valuation justified? Is the growth runway there? And if there, then what is the reason? My thesis is yes, the growth runway is there because there are like not only GLP-1, which is part of the healthcare sector that is going to boom. Like I said, many of the major players, they are vacating the insulin market. If they vacate that insulin market, जहाँ पे उनके लिए auto injector, pen injector बनाना है, so that market share is going to come to Shaily's way only because it is already there and it insulin market for the diabetes is still in its focus. So insulin capacity also it is ramping up. If you look at it, it is going to go from existing 12 million pens to almost 30 to 35. So we are more than doubling it. So next 18 months, this is the plan, and part of that 500 crore capex which we talked about is getting diverted on increasing capacity on the insulin side too. So that is the first part. GLP-1 though we already told. See, Shaily becomes more of an ancillary to the whole GLP-1 ecosystem, because innovators are the one who will take the first share of the pie. Generics, once the patent expire, players will come into play. But irrespective of innovator paisa kama raha hai, they are giving the drugs, or is it the generics player, or the demand is kind of exploding? See, the moment generics player come into play, why is the demand exploding? Because today, if we look at, I'm just giving an example. In USA, if you want to go for this GLP-1 drug, the semaglutide, it's almost $1,086 per year, because they have to go for like एक week में अगर एक injection में reusable वाला भी लेता हूँ तो there are 52 weeks. So 52 injections the end consumer has to buy and then take the drug, right? So the cost comes to roughly around 1086. The moment generic will come into play, that price will drop down to 200 or less than 200. The projection is that price will stabilize somewhere between $100 to $200. अगर 1000 से मैं directly $100 या $200 में ला रहा हूँ, तो then what I'm doing is I am taking out the cost of the treatment almost 90% down, and that is where the demand will explode. And lifestyle diseases, right? When we talk about obesity control, and obesity is a big pandemic in India also. We all know that. So at certain price point, it becomes very viable for people to latch onto this train, get into this semaglutide drug, and then board the train to get themselves cured. It's because it's a treatment of a lifestyle disease. That is where. So things are kind of like there is a synergy at a right price point. Things are going to grow, and the runway is huge. That is where Shaily becomes the picks and shovel play, which is an ancillary to whole thing. And this is like the biggest growth area for Shaily. Today, like as I said, in rest of the world and India, the patent has not yet expired. It will start only in 2026. But then all the innovators as well as the generics player who are going to target these markets in 2026, they have to do their homework. They have to ensure that they have the capacity to create that formulation, have the devices ready, and then there will be a third category of player, which is the fill finish player, which will kind of like integrate these drugs into the injectors and then bring into the market. तो जो homework होना है वो तो एक साल पहले होना है, and that is where Shaily, that is where you are seeing the uptick in the revenues of Shaily. Why? Because Shaily has created an arm in UK called Shaily UK, and they are totally into R&D itself. They have till start of the year there were only 10 persons who were part of that team. They have ramped it up now to 14. So 4 new people they have hired, and they are planning to hire for few more there. They have not given a count, but 10 to 14 ho chuka hai quarter mein hi, and they are going to hire more. Their whole intention is they come up with a platform kind of thing after discussion with the innovator. So first they target the innovators. Innovators go when they target. See, there is a slight difference between innovators and the generics player. When they are Shaily setting up the platform for the innovators, they will talk with the innovators, talk about like, okay, what is the drug and what kind of like dosage it has to be given into, and all those kind of intricacies. But at the same time, they will do the research saying, okay, this is how the end user is going to take. So what are the usual complaints of those users? So all those kind of like decisions go into it. They will do their whole research and all, and based on that, they will come up with their own design, saying this is the way the injector has to be designed. For example, if I talk about injector, it can be a dialed wala injector where like you can vary the dose, or it can be a single use kind of use and throw wala pen injector where they will say ki, this is how it is going to be. There is a single dose. It is just a push and pull mechanism. For the end consumer, it is just taking an injection, subcutaneous. They push the injection, and the drug gets delivered to their body, and then they throw the injector away. So there are different variants and perceptions to it. That is where Shaily has a major role to play, and they are a proven entity over there because it is shown by all the clients like who have come up with Shaily, and in the last 38 years, like I said, they have not lost a single client. It has only, the relationship has only grown from there. So that is the biggest runway. We talked about capex also, the capacity expansion. They are going for like 10 crores, and then based on the runway and the volume and capacity commitment they get from the innovators or the generics player, they grow from there. So this was from the innovator perspective, where how they are setting up the platform, how they are integrating them into the platform. For generics, what happens? It is kind of short circuiting the process, because innovators already platform pe aa gaye, they have already created a base. So when another generic player comes in, generic players, they will come in lots, right? So there it is just a extra set of customization as to what they are thinking about, how the formulation will be, how the dosage will be, kitna usko jana hai ek injection mein. Those kind of customization will happen. So insulin as well as GLP-1 in the healthcare is the one which is driving the runway for them. This is where the high growth area for them. I will come to this third section where we talk about Torlon. Torlon is a very high thermal and dimensional stability, considered to be one of the highest performing thermoplastic in extreme environment. और इंडिया में only Shaily is the one which is manufacturing this, और कोई company कर नहीं रहा. And where is Torlon being used? Because of the high thermal and dimensional stability, its usage is more of the like all the, how do I put it, high growth momentum wala sectors hai na. So it is used in semiconductor, it is used in aerospace, defense, EVs mein use ho raha hai, and electronics and medical devices. So this is all where this is being used in. And in India, Shaily is the only one which is producing this. So that itself becomes a differentiator, and that itself is a huge market for them. Similarly, if I look at the last part, Shaily is the only company globally to convert metal rod to plastic rod. Globally, there are other players, but when we look at the process, and because of the process optimization, what the cost reduction has come to, the process of converting metal rod to plastic rod, and when we look at the productivity and the cost optimization, Shaily is the best in the global arena, not India. At the global arena we are talking about, they are the lowest cost producer. And where do we find the use of this plastic rod? This rod is provided to Honeywell. Honeywell is their biggest client, which in turn will give to their auto OEMs like BMW, Audi, Mercedes. So high performance car mein, it is being used in turbochargers and all. So again, that is something which is very unique to Shaily, and this is again their niche area where they're a big and the front player in that. Last part I had kind of already alluded to, carbon steel furnishing. Carbon steel furnishing is something which Shaily had gotten almost in 2020, because they had got a huge contract from IKEA. But COVID hit, and because of that, they took a hit. And for the next 2-3 years, the ramp up which they were thinking of the end customer for Shaily, as well as Shaily itself, based on the capacity and the volume commitments, they had thought like this will be the growth trajectory. That kind of didn't materialize. But for the past 3 quarters, if you look at it, things are kind of picking up. And because of the pickup, now the management is talking about this line itself can become 120 crore itself, which is a huge number. When we talk about today, top line is around 787 crores, right? तो अगर उसमें मेरा एक सब वर्टिकल ही 120 करोड़ कर रहा है, तो then the ramp up is very aggressive, and on top of that they are now signed in 2 more retail clients which will also be consuming this. So this is what this is gathered from our last con call. So these are the different growth areas which we are looking at. So GLP-1 तो है ही है, but it is not the only one, and it's a good thing that it is not the only one, because things are not on ground actually, right? Only after 6 months we will know कि क्या होगा, कैसे होगा, whether they are able to execute the way they are envisaging. And 6 months may there are many things which can go wrong. There are many things which can go right also. But my bottom line point over there is things are a question mark right now, because we have not seen the execution on the ground. So GLP-1, yes, it will provide a growth way. But apart from that, insulin sector is good for them. They are doing good on the Torlon as well as the metal to plastic rod conversion used in the turbochargers. Carbon steel furnishing is already coming up. I have not talked about consumer electronics here, because that is not there anywhere in their execution right now. It is more of like the management is very keen to pursue that because again, it will be a high margin product. They are already talking with 3 to 4 clients on that, and which is at a very advanced stage. But they are not giving any direction in the sense that what is the quarter they are thinking of onboarding or when they will kind of like get into it. So right now they say ki when we are ready, we will tell you, but we are in advanced stage of talks. But that is one another sector, another business segment which I have to look into. These are all the growth triggers for Shaily, where my thesis comes into play, why I have chosen Shaily for this ALD5 presentation. Now, me being an optimistic person, like I kind of latch on to all the positive points and I look at the runways, but at the same time, we need to have a reality check also. So we talk about risk and antithesis over here. Like I said, GLP-1 is a big growth way, and if it works out the way the management has envisaged and going by the initial sign, I think it will. It will be a game changer for Shaily. But having said that, there are execution risk, and if you look at it, I have given execution risk both on number 1 and number 2. Why I have repeated it? Because execution risk is at the both sides. First thing is at the Shaily level. Why at the Shaily level? Where is the execution risk? Because the demanders is so humongous that the scalability is going to be a question. इन द सेंस कि आज हम बात कर रहे हैं कि हमारे पास 5 करोड़ पेन का मैन्युफैक्चरिंग कैपेसिटी है. We are doubling in another 3 months to 10 crores. But what happens if the demand is for say 50 crores, which is easily feasible, right? Because rest of the world and India is kind of like getting the patent is expiring in 2026. Canada and Brazil are another 2 big markets for Shaily. तो if that is the one, तो 5 करोड़ से 50 करोड़ मेरे को अभी स्केल करने में कितना टाइम लगना है? How much time it is going to take me for to scale from 5 crore pens to annually to say 50 crores, which I am 10x of the capacity. तो उतना wherewithal है क्या? Whether we have that investment money and all, and whether we can reach there, because then the management bandwidth will also come into play, right? So that is where one of the risk is whether they, and this has not been proven before. They have not aggressively kind of scaled up in this way, but the situation is going to demand them to scale up. So that is the execution risk at the Shaily level. Second, execution risk at the customer level of customers of Shaily. For example, like I envisaged, like initially the innovators will jump onto the bandwagon of Shaily, but then later on, once the patent expires, generic companies are going to come in droves. Because innovator एक होता है जिसने drug बनाया, it is kind of encashing it. Patent expires, एक innovator के बदले there are more chances that there will be like dozen of generic companies which will try to board the bandwagon. अब एक कंपनी का जो डिमांड आ रहा है, अगर मेरे पास 10-12 कंपनी का जो डिमांड आ रहा है, फर्स्ट तो वो स्केलिंग Shaily लेवल पे है. सेकंड थिंग, these generic companies again, they are betting on something which they think they can crack, but 6 months down the line when the patent expires, we have to see ki of the 12, 14 or whatever number of X number of players who are jumping into this bandwagon, how many are successful to retain the scale? How many are successful to actually push their, it's a new brand, right? Even though it is the same solution kind of which we are providing and kind of repackaging as a generic, the end consumer has to buy into that. So we have to see ki kitna generic companies will be able to make a success of it. And that is where the execution risk comes into it. For example, Shaily ने 4 generic companies को onboard कर लिया even before 2026, because we need that initial 6 month to 1 year time to get that capex up, right? And that is where they sign on to the platform of Shaily. But then they have to make it a success, and success at a scale too. Because generics में अगर वो project कर रहा है कि I'm going to get like say, I'm just throwing a number, 10 crore users in the first 6 months. But 10 crore नहीं आया, खाली 1 crore आया, then that becomes a setback. So that is the second level of execution risk. Third one which I have talked about is ramp down of high margin revenue. आज के डेट में क्या हो रहा है? Because in anticipation, Shaily is onboarding some of the generic player onto its injector platform. तो injector platform में भी जब लेगा तो there is a certain fees attached and all, that is where there you see uptick in the revenues and all. But over a period of next 2 to 3 years, it is going to kind of grow, hockey stick growth जैसा आएगा, but 3 years में it will start plateauing and then after that it will decline. तो unless and until वहां पे मेरे पास कुछ नया एक business opportunity है where I can latch on to, after 2-3 years somewhere in 28, this high revenue where we are intaking new customer onto the platform, that will start ramping down. And that is 3 years down the line, but that is still a business risk over a period of time. If starts plateauing or declining, then how do we go about it? What is the next big thing for that? Fourth point obviously is the regulatory risk, because till now, Shaily was not onto the USA markets and all, but with the GLP-1, USA is the biggest market. Shaily already has a MDSAP license. It is a medical device single audit program. And again, this is also approved by USA FDA. But, and another thing which is going in favor of Shaily is it is just going to create those injectors. It is not directly, never going to come directly in direct contact with the actual formulation which is to be delivered. That will be the job of the fill and finish companies. Shaily is not at into that. So that kind of favor is the argument that because of that, Shaily will never come under purview of USA FDA. But then USA FDA agar regulatory authority, so we don't know that. Once it starts becoming a big player and enters in a big way into USA, there is a potential that they might get audited. And the moment they can get audited, then there is always a risk there. Why? Because USA FDA may you get any NCs or an observation. What happens at some point of time, like if you get an NC or observation, those observation NCs have to clear, which might take like 3 to 6 months. For that period of time, you will not be able to use that plant for pushing your products, and that is what will kind of eat into your profits and revenues. Bottom line, top line, dono impact hoga. That is why that regulatory risk has been highlighted over here. Management bandwidth, like I said, there are already 3 business segments. All 3 are growing, albeit at a different scale. Health vertical is the biggest one. Consumer, biggest top line earner. वो भी 17% में, मतलब high margins में it is kind of growing into. And then we are talking about the 4th segment, which is nothing but the consumer electronics, which you are talking about. ये सब देखेंगे तो what we are looking at कि management bandwidth, it can kind of get diluted, kind of both, too many things to focus on. So means we leave it to the Shaily management for them to execute, like to onboard new people into their management and get this control over. But then I thought it was worth highlighting over here कि multiple business segments are all growing, then the balance has to be maintained over there. Low capacity utilization, like I said, the part of the story of the low capacity utilization is first thing is steel, carbon steel furniture. When we talked about it, but after the COVID hit, it took some time to just gain their foothold back. So that is one part which is contributing this to the story. Second part is in anticipation, they are kind of doing the capex and all, and they are getting ready for the GLP-1 story to unfold, which is still 6 months down the line, and that is where the capacity utilization is taking a hit. Management is saying that once it start like from post 2026, we will see a proper improvement over this and things will get into control. Because unless and until they didn't have volume commitment or capacity constraint commitments from their end clients, no viable business is going to do a capex just on a projection, right? So this is something which I've highlighted. Probably it will get under control, but we have to keep it monitoring throughout the 2026 as to how those numbers are ramping up. I had mentioned that Shaily is more a export-oriented business, so 75% almost business comes from the export. So obviously, with that currency fluctuation, these are going to come, especially since India has been weak against like dollar and all Indian currency. So that those also will have to be taken into account. I have mentioned capital allocation at the top because this was based on the fact that Shaily, because they are into that high engineered precision plastics and all, they went into this toy segment because they thought that will be a good margin. So they started with the allocation of 30 crores. But within 2 to 3 years, they realized that it is a very low commoditized business and it's a margin play into it. And their Chinese players were the big players and they were not able to compete with them on the margin level. So they allocated that, but then at the same time, once they realized that it is not viable, they exited. So I think they just now have a kind of foothold. With another quarter or so, they will be completely out of it. This is in hindsight, but I still put that as a risk because when we allocate do our capital allocation, we also have to take into account कि वो कितना success हो रहा है, कहाँ पे नहीं हो रहा है, whether there are missteps. Here, I wouldn't put too much blame on the management. They forayed into the segment thinking that's another growth sector for them. Within 2 years, they realized their folly. They realized Chinese players के साथ at margin level play करना, compete करना was not viable, and they came out of it. That is still kudos to them that they rectified their mistake. But then going forward also, we need to keep an eye on it कि capital allocation कैसे जा रहा है, and whether the management is walking the talk over there. So this is all the risk antithesis, and this kind of next slide I will talk about SWOT. That will be a more kind of a combination of till now what I have mentioned. So it's a more kind of thesis ka for a summary kind of thing.
So Amar, just a time check for you. Okay, so let's go fast a bit.
Yeah. So within the strengths, like I already talked about it, they have diverse end market presence, which I have already talked about the 3 business segment for they are kind of talking into. They are very strong R&D capabilities, and Shaily UK is more focused on that. Geographic diversification is there because 25% is only domestic, 75% they are exporting, and 240 plus countries and all. So I'll just run through this very fast because anyway you will get the slides, and these points, they are more kind of like a summary of what I have been talking till now. So capex burden execution risk है 500 crore already कर दिया है, 500 crores next 3 years में आ रहा है. But then we have to see the execution. If the execution happens, it adds to the bottom line. If not, then we need to question कि हमारा thesis वहाँ पे सही जा रहा है नहीं जा रहा है. Those kind of thing. I'll move on to the next slide. This again are the earning con call snippets. So basically, since you will get the presentation, I will not go through each and every one of them. What I have tried to do is latest con call में whatever I found was like relevant. I have marked it over here on the left side, and right side में मैंने उसका एक summary दिया है कि health care में उसका growth क्या दिख रहा है उनको. They are already conversing with the clients for the next 3 to 5 years. क्या commitment कैसे locking करेंगे, and commercial order for teriparatide already received. Next 6 months में वो start हो जाएगा because they are waiting for that patent expiry to kick in, right? And exhibit batches for another version of this tirzepatide. It will start in FY26. They already have 3 customers logged into it. So वो साल में 3 customer तो it's a done given that it is going to happen, and then more customers will kind of latch into it. 375 crore का ओवरऑल हेल्थ केयर का ग्रॉस ब्लॉक रहेगा, एंड विद एसेट टर्नओवर ऑफ 1.5 to 2x. सो बेसिकली व्हेन वी से एसेट टर्नओवर ऑफ 1.5 to 2x, अगर मैं 1 रुपया लगा रहा हूं तो आई एम एंटिसिपेटिंग कि आई विल गेट 2 रुपीज रिटर्न्स वर्थ रिटर्न्स. तो 375 crore का मेरा ग्रॉस ब्लॉक हो जा रहा है, तो that is almost 1.5 times it is going to contribute directly to my top line. Those are the things which I have been highlighting over here. This was more on the healthcare vertical. On the next slide, I talk about consumer vertical and the industrial vertical. Consumer electronics, I have still not talked separately because in the con call also, they have not talked much about on this one. I'll give 1 second for you to run through this, and then we can look at it in detail once Puneet shares the presentation. So now I jump on to the technical analysis. Again, I have broken it down into long time frame and the short time frame. Long time frame में देखेंगे तो if you look at it, it's kind of a ladder approach, right? It kind of gets into a certain consolidation phase. That's a breakout. It goes to the next higher level, consolidates there, and then it moves on to it. That story is kind of getting repeated. And when you see here itself, like if you look at it, this world almost 45-degree का growth जैसा आ रहा है, right? This is all stage 2 we are talking about. This is the world where the major consolidation happened. It happened till here. 445 का level break किया तो 700 level पे जाके रुका, then 1100 पे. Now currently we are looking at it like 1400 to 1700 पे it is getting consolidated. एक breakout हुआ जहाँ पे वो 2000 it crossed 2000. It has come down again, and that it crossed 2000 because of the fantastic result of Q4 FY25. तो Q4 FY25 का जब result आया ना, within 3 weeks, in spite of the expensive valuation and all, the stock gave growth of almost 30% from a price perspective. And since that run up was so swift and so fast, Once the market thoda dicey ho gaya, so it kind of gave some of the gains, but it has fallen down 15%. But then I anticipate better things from that. So this is what I'm looking at. And RSI, if I look at it, RSI, frankly, it is neither here nor there. It is kind of like on a neutral zone, 49% के आसपास में there, and overbought and oversold. Slightly, if I look from here, it kind of like gives me a tendency of a what do I put it? थोड़ा bearish जैसा लग रहा है. But like I said, it is on the fence. We cannot take a call purely on the RSI here. Shorter time frame, what I wanted to highlight is first thing, if you look at these three lines, these are the three moving averages, 50, 100 and 200. Stock price is very conveniently and for long period of time above all those three moving averages. There's this parallel channel. This way it has become a very strong support, right? Here, first time it kind of touched base on the bottom channel of the parallel channel. Then it came here second time. Now it is again here. But then if I look at it, the growth runway is there. और इसके ऊपर अगर मैं देखने को जाऊंगा तो then it becomes a blue sky for me once it breaks the upper channel of the parallel channel. So that's was my presentation of Shaily. So any questions? Open for questions now.
Before questions, people are already talking about your depth of the presentation, Somar, as always. Great.
Oh, thanks guys. Thank you so much.
So yeah, audience, questions for Amar? Only one question I think I have, when you do this valuation calculation, right? If you go to that sheet, possibly.
Yeah.
So if I see financial year 28, you're saying EPS would be around 52.
Correct.
And PE is 33.
No.
You're
So when I
assuming.
say P33, what I'm trying to do over here is price में same रख रहा हूँ. I say कि चलो rest everything being equal, अगर मेरा price 1800 पे ही रह गया, तो अगर मेरा 52 EPS आया, तो my derived P is going to be 33 because my price is at 1800. But I'm expecting my price to grow from 1800 to 4500, so probably P will again be 70 plus.
Okay, that way.
So I'm keeping that static कि अगर मेरा 1800 ही प्राइस हुआ जहां पे मेरे को ज्यादा नहीं जाना है, तो जो एक्सपेंसिव वैल्यूएशन है मेरा वो कम होते जाएगा based on the earnings which is
Forward P, basically,
high
you are
growth
doing
earning which is coming up.
Forward
Sorry?
P at the same. You are doing forward P at the same price. I got it.
Correct. Same price. Yeah, I kept it same.
Yeah. Okay. I don't have. Let me check on the chat if somebody has any question. No, I think we don't have right now. Maybe people may ask in the chat later.
Yeah, either in the chat or they can ask in the group, and
Group also.
I'll try to answer to my capability.
Sure. So, guys, audience poll also will do right away. I think Amar will take you through the audience poll. 2 questions only.
Yeah.
Then,
I will.
Then we'll break for a 10 minutes break possibly. So audience poll, everybody I think is aware. 2 questions will come one by one, and you have to just select the option A, B, C, and you have to type only option numbers, not write the full answers basically. So if the answer is A, you type A in the chat. If it is B, you type B in the chat directly. And both the answers has to be correct. Then only you are eligible for the fastest fingers. So yeah, Amar, you can take the.
Yeah. So if everybody is ready, I will start with my first question. Like Punit mentioned, you have just to give the option. We will let it run for a minute or two, and then we'll move on to the next question. So the first question coming, be ready with the fastest finger. So be alert, guys. My first question is here now. There it is.
can stop here. I will put drop a message.
Yeah. I'll move on to the second
Wait,
question then.
wait.
Okay.
Let people complete that. Okay, we have stopped for the first question. We'll move to the next one.
Yeah.
I think we have enough answers. So we'll stop here.
Yeah.
Okay, then let's break for 10 minutes. 12:15 we should be back. I think 12:15, let's say. 12:15 is okay.
Yeah, sounds good.
Yep.
Thanks
So,
all.
yeah, Veena will come back to you by 12:15. I made you the co-host already. Yeah, Meenaji, screen is visible to me. How many of you are back, guys? There.
I'm here, Puneet. I'm here.
Okay, then we can start, Meenaji. Meenaji, I'm not able to hear you. Somebody else able to hear Vinaji?
No,
No,
Puneet, we
Puneet.
cannot.
Okay, she just put a message that she is some audio issue. She will come back in a minute. So yeah, you can announce the winner by that time, Amar.
Sorry, I was speaking on mute, Puneet. I thought you were doing that, Puneet.
Okay, so yeah, so both the answers are given correctly by Arun. So the first question I think was the more trickier one, right? What about the investment that will go? How much amount? And most of the people, I think, went from 10,000 to 20,000 and back to 10,000. But since it's a margin one, so it's zero basically. So your 10,000 goes away. The 10,000 belongs to other parties, right? Brokers and other things. So that was a tricky question. Another one was simple. I think that one everybody should know. If you're buying a stock and if your company defaults, you are last in the line basically. So that is the highest risk of losing your money if company is not going great in terms of solvency and liquidity issues are there. If it is brought to NCLT, you are nowhere. And the creditors or the loan people who are giving the loan are first in the line basically. So yeah, Vinaji, you can try now if it is possible.
Yeah, I think she started it out now.
No, but we are not still able to hear you.
Am I audible now?
Yes, yes, now it is. Great.
Okay. So I'll start, okay?
Yes, yes, yes.
Sorry for that glitch. So I'm talking about a small company, which is Standard Glass Lining Technology Limited. It is a very newly listed company. The IPO was recently in January. So this company is a niche company, and what it does is it is actually an equipment manufacturing company, and they manufacture glass-lined stainless steel and nickel alloy-based specialized engineering components, equipments which are used mostly in the currently they are mostly given to the pharma industry and to the chemical industry. So there are some specialized polytetrafluoroethylene pipelines and fittings, and this company is a supplier of that. So currently they have 65 different variety of equipments, and they're doing 3 different kind of sales. One is the loose equipment sale. Second is the customized equipment. And third is a turnkey solution. And their capability to manufacture these equipment, the current capability, it ranges from the thickness from 1 mm to 60 mm. And in future, they are planning to go up to 150 mm. So they are planning for a new plant for oil and gas and heavy engineering, where they will be required go up to 150 thickness mm. So this is actually niche. So this is not only in the thickness that you require some quality or the niche. It's also on the pressure side. It should be able to the equipment should be able to what we can say, withstand the pressure from very low pressure to the very high pressure. So currently, as I said, mainly they are catering to two main industry. Currently, they have a 99.6% domestic sales and very less of the export margin. So 82% is going to pharma industry, 12.5% is going to chemical, and the remaining it is going to some small agro-based and food industry. So mainly they have three business lines: reaction systems, storage, separation and drying systems, and plant and engineering services. So these are some of the equipments. I've taken it from their website. Some of these equipments that they are manufacturing, mostly the heat transfer system, pipes and fittings, pumps, reactors, heat exchangers, storage tanks, and some of the services and utility systems that they are doing. So they are into sales, manufacturing, servicing, and in future they are planning to also do a build, operate, and transfer. So the complete end-to-end solution. So just not selling the equipment, but also the complete end-to-end solution for the customer. So currently this company, it has about 600 crores of sale. So which is a very minuscule amount given the total addressable market that is out there for these systems. Now, there are big players already in the market. The competition is there, but the competition is not. So how do this is different from the competition is? The competition is maybe having 4 equipments in, let's say, heat exchangers. They may be having 4 products, 4 or 5 products. Someone else may be having 4 or 5 products in the other area. What this company is trying to do is kind of become a supermarket of equipments for the industry. So if it's a pharma industry, so related to pharma, these equipments should be available with them. And the total addressable market is very large. I'll come back to this slide. And how they are trying to address this total addressable market is by having a 20-year global strategic partnership with the AGI group and the GL Hako Japan group. So Asahi Japan have invested 175 crores in this company, and they are the second largest shareholder. Before going public, this company, it was all a family business. There were 3 different companies which they merged into a single company. So they cleaned up all the balance sheet, and then before the IPO, so along with the IPO, there was Asahi Japan, which came in, which is the second largest shareholder. And the technology which is coming, the niche technology that is coming from this Japanese group. And this particular thing, shell and tube glass lined heat exchanger and other technologies, this is like unlocking a 2000 crore opportunity only in India. So, and globally, we can imagine what this opportunity would be like. I'll come back to that earlier slide a bit later on the global total addressable market. So then why is Asahi Japan not going directly and coming in this company? Is they have seen the MD has a partnership with them, and they this particular company, it is giving 4% royalty for the domestic sales and 7% royalty for the global sales. And can Asahi Japan give this technology to someone else as well? So this technology is so much niche that this Japanese group, they have not even patented the technology, because we know that the patents are there for 20 years. Once you patent it, you have to give all the details, and then someone else can also build that technology once the patent is gone. So that particular thing is taken care of there. Then there is another partnership which is there with the IPP, which is an International Process Plants and Equipment Corporation. And this is a USA based company, a very big company. They have around 156,000 clients. And with this company, the tie-up is that they will sell equipments of SGLT, of the standard glass lining technology, to these clients. And there will be a tie-up for the service revenue as well as the sales revenue. So that is another tie-up that this company is having. Apart from the Europe and US tie-ups and the Japanese tie-up, there is one tie-up which is there with a Singapore company, which is a Biocon PTE Singapore. It's a recent tie-up. And with that tie-up, they are trying to cater this other market. Okay, so the Asia market. And there are 2 certifications in pipeline for Europe and US, because we know that in the pharma industry, it is a very strict industry. Just now, Amar gave a very nice presentation where he mentioned about the FDA and the other things and how stringent they are on the norms. So even the equipment manufacturers who are manufacturing in pharma or these chemical, and they are supplying to them, they have to follow stringent certification. So that is what this company is in pipeline. There are 2 certifications. They have not get them recently. They have not got it yet, but there are 2 certifications which are in the pipeline, which will help them to increase their sales revenue. There's also a tie-up with Atlas Copco. Now, Atlas Copco itself is a very big giant, a very big company, and it itself is an equipment manufacturing company. But there is the way the tie-up is that this company has a private label agreement with them, so they will get the equipment built from Atlas Copco, label it their own, and do the sales. It is for one particular segment of the equipment which they are not building in-house, and they're getting it built from the Atlas Copco. So what they are currently, they have about 8 manufacturing plants, and most of it is in Telangana. And with this IPO proceeds, so this IPO was about 410 crores, out of which 200 crore was offer for sale and 210 was the new fresh equity. So with that, they are also planning to build a 9th facility where they are. So it's a new facility for particularly for oil and gas and heavy engineering, where they'll be building the new equipments. So they are increasing the production capacity. Also, the increase in production capacity is currently whatever manufacturing capability they have. They are trying to get in robotics so that they're not dependent on the the manpower crunch and the supply crunch. Manpower supply crunch we see generally in the manufacturing area. That's actually a very big headache. So with the robotic facility that they are getting in, their supply, the existing supply itself, from the existing 8 plants itself, they are expecting that they will increase the supply at least 2 to 3 folds. The scaling operations is by doing a lot of tie-up and naturally onboarding new customers and introducing new products because they are very much sure of the strategic partnership with this Asahi group as well as their in-house technology that they have. The client, these are current clients. So from the listed clients, that the NSE, there are 80 listed companies on NSE, the pharma companies. out of which these guys, they are supplying to the 30 companies. So Dr. Reddy's, Cipla, Aurobindo, these are some of these companies that they are supplying to. And so most of their revenue is coming from the top 20 customers. So last 3 years, they have very good relationship with these customers, and most of their revenues means about, we can say about 60% of the revenue is coming from the top 20 customers. And they have a long-term relationship with these customers. And naturally with these new tie-ups, and these tie-ups have happened in the past just about 3 to 4 months. So that revenue probably we will see in near future. When we hear the MD speaking, he is very much excited for the coming next 3 years. And he's saying sky is not the limit for the way that, this company will grow. And he's very much excited that with the Japanese investment and their technology, and with the IPP plus the Biocon, Singapore, all these tie-ups, that the sales will, at least there will be a 25% CAGR for the next 10 years is what the MD is forecasting. I think this I've talked about. So this is the current facility, mostly in the Telangana area. And there are some numbers here, but naturally these numbers will change drastically once, the new, once this partnership fructifies and they will get more orders. So the company is also saying currently we are exporting just 0.5% of the sales, but within this year they are expecting that it will grow to 10% of the exports will grow 10% of the sales, and within the next 3 years it is expecting to grow to the 50% of the sales. That is the target. And actually we know that the more the export is, the better it will be for the margin. So looking at the financials, these are the current financials. So the total income from FY22 to FY24, it is a CAGR of 51%. Similarly, EBITDA margin and the PAT margins. But this is because there have been acquisitions. So S2 Engineering Services, so there are 3 acquisitions that happened. S2 Engineering Services, Stanforms Engineering Industries, and CPK Engineers Private Limited. So they all complemented the existing capabilities, and these were the brownfield acquisitions. So the revenue got added up. All right. So we see a jump from FY22 to FY24. But if you look from FY23 to FY24, okay, here you would just see like probably a 10% increase in the income. Here as well about 20% increase in the EBITDA and the margins, and this is also about 10 to 15% increase in the PAT margin. So the thing to look is, so sales is also in March 25, it was about 600 crore sales, and the profit is about 69. So if you look at it, sales to net profit is about 10%. So why are we looking at this company is because of its growth potential, and it is just a very newly listed company. So if we have to invest in this company, we have to actually look at how this company will really perform, and whether whatever these guys are speaking about, will they be really able to deliver it. So the potential is there, but we need to keep an eye on their execution. Now the equity capital, you will see that their ROE and ROCE actually have decreased over the year. That is because there is a lot of infusion of equity in this year in January. So because of it, their other ratios have, they drastically will see that there is a decrease. if you look at the peer comparison, now there are some very big players out there, and in front of them, SGLT is a small player yet. Okay, so comparing with very big players is, I don't think it is a correct thing to do. But if we compare it to GMM Fodler and HLE Glasscoat. Now, HLE Glasscoat also is a different kind of a lining technology, but the technology that HLE Glasscoat has is more of a coating technology, and the technology with standard glass lining is a very different technology. So it's not just a coating on the thing, but there is a technology in which they will apply these different kind of layers on your equipment so that they are able to cater to those kind of temperatures and pressures that is required for the manufacturing of our pharma industry. So I believe the reasons to invest is, one, the export jump which will come in, and the tie-ups these people have with IPP and with Biocon. It will give them a direct access to the new geographical regions. The second reason to invest, I think, is about the technology which will come from Asahi Japan, which they have a 20 years license agreement with them, and the immediate pipeline, the immediate which Asahi Japan is giving them is the shell and the tube glass lined heat exchangers. This should immediately come to their bottom line. So if we see about the total market currently, see, this is just about a 600 crore sales. But if you look at the total addressable market, okay, so the total addressable market in India as well as globally for each of these segments is actually very large. And currently they are doing a very minuscule, they're catering to a very minuscule amount of this market. Okay, these are all in billion INR, and this is also a billion USD. Okay, so looking at the total addressable market, and if these guys really execute the way they are saying they will execute, then the 600 crore sales in 3 years could easily be 3 times or 4 times the sales. So that is the launching of these pioneering products. That is the another reason that we can invest. And so this new facility that they are the 9th manufacturing facility that they are building in Telangana, that they are doing it for the new user segment. So they want to get into oil and gas, heavy engineering, edible oil, paints and coatings, flavors and fragrance. They have already got on board Nestle. So for a food line, they have got Nestle on board for their equipments. See, once we get Japanese go ahead, and we have big companies like Nestle or the big companies in 1 or 2 of these areas, then the others will follow suit and orders will come to this company. Currently, they are net debt free and they have a good cash reserve of about 266 crore. And as I said, the MD is very excited whenever I hear about hear all this, videos from the MD. He's very excited and he say that FY27, FY26 will be the launch pad, and FY27 this balance sheet will be drastically changed and it will be a transformed balance sheet. So for at least for the 10 years, he's saying a CAGR of 25%, and I think 25% is the minimal CAGR that he is saying. But given the way the market can unfold, it could be even more than that. So what is the key risk is, currently the top 10 customers, they contribute to the most of the revenue. So that is one of the key risks, but they have very good tie-ups. Then in the cash conversion cycle in the last year had gone up tremendously. And the one of the reasons that was said was that pharma industry was going through a bad patch, and most of these companies, so most of the client of this company is 80% is from the pharma segment. So their this recovery was a bit late. So this is what we need to take look further also. So every quarter we'll have to check on their cash conversion cycle as well. Execution risk is one such risk, and how they do the future capital allotment. So currently the capital allotment is going on well, and in the future how they do the capital allotment, that is the risk. So as I told, their IPO just came in Jan 25 with a price band of 133 to 40, and they utilized it for capex for the new plant, then repayment of the borrowings, investment in the subsidiaries that they all then made it into the single company, then inorganic growth also they want to fund, and some other general corporate purpose. So they are setting up this new facility on a 36 acre area, and it is in the phased manner they are doing. So they are not going, all gung-ho in one go. Very phased manner they are taking up. And currently they are taking up for heavy engineering, oil and gas, and edible oil. And once that is stabilized, then later on they will set up new facilities. So these are some different details, that 10 crore from machinery upgrade, 30 crore for investment in subsidiary, 130 crore for loan repayment, and the remaining they have kept in a FD. So price wise, you would see that, so this was when it was listed, and the lock-in period was in two tranches. Lock-in period was there. One ended in the March, one ended in April. Okay, so here the lock-in periods ended actually in March and April. So probably some of those who were invested earlier, they sold here, and once these earlier investments are gone, so this is what we see back. So this looks like a small company, but with a very high potential. This is the leadership team. So this Nageswar Rao, he is the main guy who's actually driving the thought process and the business. And he was actually from 96 to 2001, he was in ITC first. Then he had built his own business in mechanical seals. He had sold this to that MNC, some MNC company. He was MD there. And then in 2011, he had friends in these pharma companies, and that is how he got these ideas. Like his friends were telling him that there was a waiting period of about 20 weeks to 30 weeks. And the waiting period to get the equipment itself was so much duration. So can he build something for them so that their lead time, etc., would be less? So that's where he got that idea. And from 2012, so if you see at the company from 2012 to now, so about 12-13 years old, he's in this business. Most of the shareholding is with the family itself, and the second largest shareholder, as I said, is Asahi Japan. So yeah, this is about the company. Any questions?
Yeah, good details, Minaji. I think you've covered it well overall. So only one question which was coming to my mind was, see, currently it is in a downtrend in terms of the sales and profit overall. Maybe the margins are reducing. Any reasons OPM is going down, if you know?
Any questions, anyone?
So, are you able to hear us, Veena ji? Hello.
You are audible.
We can
Puneet.
hear you, Puneet.
But Veena ji, I think, is not able to hear us, possibly.
Correct.
So is someone asking something? I'm not able to hear.
Okay, then we will put questions in the chat to you, Vinaji. Overall, you have covered the company well. Only one question I have is why the OPM is a little bit going down. Is there a short-term measure or something which is changing in the company?
Hey, hi Puneet.
Is someone
Hi,
asking something,
Prajot.
or am I not able to hear? Are there no questions?
Hi, Prajot. You have something?
Yeah, hi. So yeah, I mean, along with OPM, just one question. Everything looks good with this company. Just that if you look at the inventories and trade receivables, so like inventories have gone 2.5x in last 3 years, and trade receivables have gone 3 times. So if you like add inventory and receivable, they have become as good as the current year revenue. Okay. Now margins have been really good. Hence, ROE and ROC was looking um, like strong. But like you mentioned, this year the margins have stopped falling. But uh, the margins have been very good because of the differentiated product. So their product has a capability. Now, one thing we need to check here is, as the MD was mentioning, that the next couple of years balance sheet will be really good. So what they will be doing to fix this trade receivable and inventory, and the product itself is a differentiated one. So I believe margins may come back, but why the inventory and trade receivable have gone 3 times? So that is the only thing we need to check with this.
Yeah, correct. Actually, so what they're saying is margins will go very nearly in the near future. Next year, they're saying up to 15%, because export growth is what they're looking at. So from 0.5% export to a 10%, and then eventually to 50% export is what they're looking at. And we all know export margins are
Higher, right?
actually higher than the domestic ones. So that is one. The last year's receivables, they said, was because there was a issue with the pharma companies, and pharma companies cycle was not good, was what was mentioned. But when someone asked how they will fix, there was no answer to that. So
Um,
so that is one red flag which I found. So we have to really look on how they will fix it.
right.
Currently, they are saying that they will take a 30% upfront payment and 70% on pro forma invoice, is what they mentioned. But because I saw this, this large cash conversion cycle, I think they're not sticking to it. There might be some long-term relationships because of which they are giving some leeway.
Right. And when I was checking HLE Glasscoat, which is a peer,
Yeah.
similar observation is there. It's just that the trade receivable and inventories are like half of their yearly
Yes.
revenue. But
Yeah.
in SGLT case, it is like nearly their current year revenue. Yeah.
Yes.
So yeah, we will look at the execution because with this detail, we were just trying to find out like what would be the right valuation we can give to this company, or like an entry point. So yeah, thank you for your clarification, and thank you for a good, nice presentation.
Thank you. So that's why I said, so we need to look at the investment. So so I myself is not 100% convinced on should I jump in right now and buy it, or should I look for at least 1 quarter how they are performing, and keep on, this company can be on our radar, and probably we should just look at how they're, so whatever they say, are they able to deliver it?
True.
True. Yeah. Thank you, Vinaji. So we'll move to the next presenter, Kamal. And any other questions to Vinaji, please put in the chat and we can answer or take it from there, or maybe in the WhatsApp group also, it's fine. So Kamalji, I have made you the co-host already. Just check it. Yeah. Yeah, we are able to see your screen. Kamalji, you are speaking. You're on mute. Looks like. Hello, Kamalji.
Unmute. Okay. Am I audible now? Are you able to?
Yes. Yes, you are audible now.
Okay.
Please go ahead.
Okay, thank you for the opportunity, and I think Bina, Amar, everyone has given their best, and congratulations to all, and thank you all. Okay, so right now I'm going to share one company, OBSC Perfection. It is an SME company, and so this is basically, you can say, machining, investment casting, then precision tools manufacturing company. And this, as always, a disclaimer: this is for your information and study purposes, not a SEBI registered stock advisor, but I am a mutual fund distributor. So I requested Puneet to share the charts because I am not advisable to do that actually. So please consult your financial advisor or do your own research for investing in it. And first of all, this is an SME company, and you know SMEs have its inherent risks. And when I shared this stock to Praneeth, actually that time it was around 200, and I'm invested in that and biased also. So even I didn't know that it will run away so fast because of the recent orders they got when I started preparing this presentation. The order book almost swallowed to almost, you can say, 40% more. So let's go ahead with the business overview. This company was established in 2017, 2017 actually, right? So this is part of Angelin Omega Group, which has presence in bright steel bars, electric mobility, and auto components. And this company is 55 years old, and they owns 36% of its ownership. So the business is manufacturing of wide range of precision engineering equipments, metal components with a product portfolio of over actually 20 products and 200 SKUs, right? So now they are mainly into the EVs, auto components. Non-auto components include defense, marine, even telecom towers, as I predicted, as I provided on the right side. So they export these things to UK, Europe. Germany is the main customer, Italy, US. So let's go ahead and I'll discuss everything. There are 5 manufacturing facilities I will cover in the next slide. It is more than 20%. Export share is, I think, 25 now. Export more than 10 countries. They have 83 crores of the gross block. Order book, when I started making this presentation in the March, you can say they had 720 crores odd order book. Now it has swelled to 1,000 crores. So you can say now in two months, it is approximately 286 crores of new orders. So approximately 800 plus workforce and 700 blue collar jobs, and more than 90% of their customers, employees are kind of with them for a long time. So you can say employee satisfaction is too much in this company, and that too in the manufacturing company is good. They have grown tremendously, approximately 37% CAGR over last 3 years. Operating EBITDA is very good, and profit growth is awesome. So the marquee clients are basically top international clients are ZF Commercials, Jetty, KE8, then Kongsberg, Tenneco for Asia, and Lear Corporation. So Tenneco is their main customer out of the all, and ZF Commercial also is a very good customer for them. But the maximum order in the EV and the auto components they are getting is from Tenneco, and recent 286 crore orders all are from Tenneco. Then Tata Auto Components. Tata Auto Components, they are kind of single source supplier for certain Tata Auto Components. So basically, you can say Tata is dependent on them for certain components because they are single source. So it is kind of making them a sticky customer for them. In case Tata has to change, then they have to, you can say, provide all these specification. Then you know the kind of things they have to go through, and it takes around 2 to 3 years. So then we will go to the major customer things. Tata Auto Component, ZF, and Tenneco. They are their main customers. Rest all are also getting good with them. So they are expecting more orders from all of them to decrease their customer concentration. Now about Angeline Group. So they are basically 5 years old. You can say established around 1970 growth, which is mainly into the steel bars, auto components, and uh, electrical mobility industries. So they are having more than 30%, 35% shareholding in that. So they manufacture a kind of steel bars, carbon steel bars, and they have two facilities in Pune, and out of that, one is in Pune and one is in Chennai. So that's all about them as of now, because we are more concerned about OBSC. So as I told, this is the company that is established in 2017. They are having 5 manufacturing facilities. 4 manufacturing facilities are in Pune and one is in Chennai. They are also expecting the 6th facility that will operate from Gujarat. So this is all about the unit 1. They established in 2018. This is their own unit, and this is particularly for machining and running at 88.8% of the capacity. So, unit 2 established in 2022 is leased and is machining and investment casting. This is 80% utilization. Investment casting, that is basically we first create the plastic molds and then we cast the things into them. They are basically bit rough kind of stuff, and then they need machining. And this is also like this is in the Pune 2 unit. Unit 3 is in Chennai. That is also machining, and most of the auto components are made there. Means the machining components, and because you know the Chennai and Pune both are auto hubs, so main auto components are made in those 2 parts. They are like they had their IPO in October 24, so they are using some capex from them to increase those. They are using 5 crores of capex to basically increase their components out of that. Unit 4 is in Pune, that is again in machining and using 75% of capacity. The 5th unit, they were supposed to basically inaugurate in basically second half, sorry, Q1 FY26, but they started already. So they are already started and expected to be fully operational in next 3 months. So this unit 5 will be more or less be used for the defense purposes, where they are going up the value chains to increase their exports, to increase their dependent to lessen their dependence on the auto components more and diversify themselves. Gujarat, I already told you. So this is about Unit 5, newest facility inaugurated in April 2025. Commercial production will start in basically late 2026. Forging capacity, it is basically hot and cold forging uh, facility, right? So they are going up the value chain, as I told you. So earlier they didn't have both these things. Now they are planning these 2 things in the Unit 5 of the Pune. Basically, this will be defense focused. So now currently they have 133 crores of the defense orders. If you see, I'll come to the next slide. They are just 5 crores of the defense orders earlier. So they are expecting more revenues from the defense and more margins definitely from them. So this is all about their financial highlights in H2. H125, it was basically 68 crores, and H2 is 76 crores. And year on year, we see if we see 12.3% growth. Basically, you can see that revenue is up 25% year on year, EBITDA is up 27% year on year, and PAT is up 37% year on year. And they have the margin expansion as well. Export revenues were approximately 29.7 crores, and 114 crore revenues were from domestic. So they are trying to export more to increase their revenues as well as margin expansion. The current order book I have updated today only, it is 1000 crores because they got 29 crores order just today. So undertook sorry, it is 33 crore I think. Undertook capex of 3.3 crore and net worth stands at approximately 103 crores. Earlier, before the IPO, they had a debt equity ratio of 1.38. Now it is 0.26, and they have almost repaid their debt and expecting to be zero debt company soon, because they are now expecting more revenues and better profitability. Maybe they keep some debt, but this is very negligible debt to equity. So future growth strategy is value chain move up, because I told you already, hot and cold forging facilities in fifth unit of Pune. So this will enable them to make more complex and larger parts. New industries like defense on focus on defense, marine, and renewables. So they are also getting their foothold on the EV components more. So they are planning to increase their defense share to 5 to 40% actually. So, but they are getting more and more auto orders as of now. The last 286 crores, all are, you can say, auto components, and then again from the same customer. So let's see how it goes. But it is 2030. It's too late, but it is having an ample amount of the time. But let's see how the future unfolds. Exports, as I told you, like they are targeting to maintain 50% of the CAGR over next 3-4 years, and they want to export more and more, and up to 35% of their revenues, even 40%. With again, I'll cover later. Again, all the new orders are from Tenneco, which is again export. So they have already increased their export share for the new orders. So they are using advanced machines. Basically, they are not only hot and force capabilities, advanced CNC machines, and various other advanced machines they are installing. So moving up the value chain, they are also establishing a new aerospace division, which will be high margin accretive. So they are doing many things, and you can say these are all related. So kind of what we call is forward integration. So because they will kind of use the same parts, same facilities, and they are already first backward integrated, and now they are going towards the forward integration to go into the more advanced things. So let's again, this is a SME company, and but they are from their con calls, they are looking quite optimistic and were very confident. So again, they are kind of there was a scuttlebutt of my friend with them. So they were so confident. They are saying 95 to 99% they have kind of the precision of the uh, equipments they are making. So nobody has even sent back. Sometimes out of the 10 consignments, nobody has sent back even a single element to them. So even if they get back like 1 or 2 machining parts, they are not worried, and they know that we will again send it them to back, or we will manufacture new, and we don't mind that. So they have got from BEL zero defect award. The defense company, you can say that they have got zero defect award, and from JEDF, Tenneco, then another for Asia, they have got various like awards like good supplier, strategic development, customer support awards, which is like, you can say, the quality and the uh, kind of reputation they have with the foreign customers, which we think is very rare to get. And as I told you earlier, they have a very good CAGR for the last 3-4 years. They have grown approximately 36% CAGR. So this is just a revenue segmentation. As I told you, it is Italy, Germany, US. US is not a very good high part, but as Tenneco is a US company, and ultimately they supply it to their other parts. So like the recent order book from the 160 crore orders, they will supply it to their German subsidiaries. And from the 97 crore, the recent order, they will supply to Volvo Tesla, which is US based. So Tenneco itself is a very, very big company and having, you can say, geographical presentation all over the world, be it the Africas, be it the North Americas, be it the Europe, even they have presence in India. So you can see the kind of orders and geographically presence even this company OBSC is getting, because they are manufacturing it for Tenneco and they are supplying it to their German customers, right? So this gives a lot of kind of confidence, because if they are providing it to German, they have not disclosed the customer. Obviously, we know the German automakers. So it's kind of the perfection they are getting, kind of orders they will get in future, and the diversifying into EV components, which is the future. So I am very optimistic about this company. This is the financial track record we have already discussed. So this is the order breakdown, industry-wise split, as we already talked. This is 743 crores in the domestic order book. Sorry, it is automotive. So I think this is labels were wrongly labeled. So this is the domestic 743 crores, non-automotive. Sorry, this is automotive, the blue one, and 257 crores is the automotive, non-automotive, sorry. And geographical split, this is the geographical split. Domestic is 553 crores, that is 58%, and exports are for 447 crores. And when I started making this slide, the export orders were 25%. So now they are targeting 35% exports. Right now, the order book is saying something else. So let's see how they execute and what is the first order execution. And if they are like doing it parallelly, then their kind of guidance is already met. So I have already explained that. So this is all in the chart actually. So this 256 crores order are simply received recently, and those are mostly from the for the EV parts. So earlier they were having 247 crores, 447 crores from the EV. So now they will be having, I think, approximately 700 crore for the EV. So the margin expansion looks good as they have guided in their con call. So this is the financial projections and revenue guidance they have given. So they have given a revenue guidance of 40% year-on-year growth for next 3 years. So Nuvama forecast, I've used Nuvama reports as well. So their forecast is 193 crores for FY26 at 35% growth, and 272 crores for FY27. But when I will come to the valuations, I have kept it moderate. Revenue mix shift. Automotive revenue is expected to decrease from 91 to 70% in next 2-3 years, and non-automotive for 35%. Margin expansion, they are expecting their margins to expand 4 to 5% in the future. If they expand this kind of EBITDA margin, Nuvama is forecasting their profits to go up 50% in next 2 years. And EBITDA margin to 21% because the currently EBITDA margin was 16-17%, something around that. Capacity expansion, we have already discussed. They had 30 crores from IPO proceeds, 5 crores are going to Chennai facility and 24 Pune. Rest 5 they have not disclosed yet. Debt and return ratios before IPO, after IPO, their ROE fell to 16%. Earlier it was 40%. Because of the equity dilution, you can say that. Now management is very, very optimistic to increase back to 40% in next 2 years. That is already reduced. Working capital, they have a large working capital days of, you can say for domestic is 60 days and exports for 120 days. Defense is 45 days. But now they are trying to get the bill discounting scheme to bring down the working capital days for the exports companies, the foreign companies to 20-30 days. If that happens, then there will be no crunch of the capital for them to work around. So these are the valuation matrices I just corrected in between the call itself. So their number of shares subscribed is 245 crores. Today CMP is 300 crore. So this is the margin guidance. I have taken, Nuvama has expected 40-45% yearly, but I have kept it to 35%, 38%, 38% average of that. So EBITDA will come around 38 crore, 53 crore and 74 crores for the next 3 years. EBITDA margin currently is 17.8%. I have kept 20%. Nuvama is expecting 21%. So I'm already going on the lower side from Nuvama. Though management is also giving 4 to 5%, means they are going beyond 22%. But I have kept, you can say, a kind of base case or less bullish case. It is not the bearish case, definitely. Above the base case and less than the bullish case. Profit will go up 23.5, 33.5 approximately according to the EBITDA margins. Profit after tax margins will be 12 next year and 13.5 for next 2 years. EPS will come around. Sorry. EPS will come around 7, 9.6, 13.6 and 18.724. Where's how? Last line is actually P is kind of, let me show it, check it on my PPT actually. So the P will come around, you can say 43 for FY25. FY26 it will be 31. Forward P it is. And FY27 it was 22 and FY28 it will be 15.8. With the margin expansion, they are kind of likely to achieve that, but this is with the current CFP. Looking a bit costly, but as in the case of SMEs, we know that if we get 5 companies right, then if we invest in 5 companies and get 2 companies right, then you can make a massive wealth. And if another 3 companies you think are not earning well, you can get out of them. So, but this companies right now, I'm thinking is getting expensive. So you need to definitely track this company as per my view. And when you feel okay with the valuation or the kind of you can say confidence you are getting, then you can look to means invest. It is not an advice, but it is worth looking and worth tracking, in my view. So because it's a recent listed company, there are not much disclosures. I went through the DRHP and con call as well, but there are no any known corporate governance or compliance issues. Related party transactions, because Angel and Omega Group is their own group, so they have some kind of transactions with them for manufactured parts or supplying. So next slide is the key risks. The major risk is kind of top two customers constitute now for 50% of their order book. So loss of any could impact the revenue, but as I told, like Tata is not likely, but Tenneco, in the geopolitical conditions going on and US tariff issues, though they have told that is not going to impact them, rather China plus one is going to benefit them. But let's see now this Iran-Israel war is going on, Red Sea issues, and supply chain issues can definitely impact, and that we don't know. And then high automotive reliance, so they are not much diversified into the other industries. Raw material volatility, it can now easily impact if the crudes are going up, and leased facilities. Now they have three leased facilities, release renewals, anything can disrupt their operations. And this is a low float. Basically, sorry, this is not 48 lakh, it's 2.48 lakh shares in the market. And but the government, sorry, promoters have very good skin in the game. They are approximately having 73.7% of the 73% of the, you can what we say, the stake in the company. So their management is quite effective. Their managing director Saksham Likha is a kind of very highly graduated, and he's more focused on the customer additions, product and technology developments than Ashwini Likha, that is kind of having 35%, 35 years of experience in the precision engineering. So both these guys are having a very good stake in this company along with the Omega Group. So on the things. Conclusion is that it is a rapidly transitioning company from a precision and auto component company to a diversified precision engineering company with strong thrust on defense, marine, aerospace, and EVs. So I have used these resources to present this company. So not much disclosures, no previous history as of now. So definitely it needs worth of research and then tracking as well. But as an SME company, now the management is saying they will provide a quarterly update, which is a big thing. No SME companies, as Puneet knows, and most of you must be knowing that, provides even the updates after 6 months. But they are promising quarterly updates for any disclosures that are happening. And whereas any SME company is expected to provide the disclosure after or presentations after 6 months. So that can speak about their kind of integrity, confidence, and the, you can say, execution capabilities. So that's all from my side, folks, and that's all. Puneet, any question and answers?
Thank you, Kamalji. So the stock just ran away last week. Otherwise, it was at a very good price a week or so before. And this is one of the companies we also discussed in ALD4, I think, by Sanjay ji. So the things are looking good for this company, but definitely it's a SME company, and one should do that due diligence also, because very difficult to average if things go wrong, very difficult to exit also. So please take care, but definitely it belongs to a very bright group in the background, 50-year-old group basically, doing very good things. So you did it well to cover it, Kamalji.
Thank you. Thank you, everyone.
Yeah, hi Puneet. Can I ask something, please?
Please.
Kamalji, any idea how much, what percentage they are using of their facilities as of now? So
I've already provided.
What percentage of the total capacity that they have installed, how much they are using, and probably after where they'll probably need to get more facility, right, to grow. So this much is good for how much turnover for them. This
So they have not provided any updates on this, Sanjay ji. So, but they are like in the Pune 2 unit, right? They are 80%. In Pune 4 unit, they are still 75%. And Chennai facility is almost 90%, and Pune 1 facility is 88%. Now they have Pune 5 facility, right? That is
sir,
14.
Chennai का आपका थोड़ा ये गलत है. It's 30% is utilized. Chennai में is only 30% utilization as of now. 90% नहीं है.
Chennai का 30%. Then I'll check and get back to you, Sanjay.
हाँ, नहीं, Chennai is only 30% utilization as of right now.
You might have got wrong then, because I checked. Okay, I'll check and get back right now. Right. So अभी पुणे का start नहीं हुआ है. So let's see how it goes. And they are also planning to come up with a Gujarat plant at Sanand. So they have not.
Any idea for which customer that Sanand plant is coming up?
No, they have not provided yet. They will. They told that they will provide the updates in the next con call.
Okay. And also for Tata Autocom, they provide any idea of the final customer?
No, they have not disclosed it, because Tata should itself be a customer. I think they have many investors.
Tata Autocom. No, Tata Autocom is not the customer, because if you hear this, I think he said Tata Autocom is for Tesla.
No, Tenneco is for Tesla, right?
Tata Autocom also, aluminium parts that they're making is for Tesla. For the cooling plates, it's going for Tata Autocom. They're making 6 parts. It's going for Tesla. He said that on the. He said it on the con call that he had, no, for the when he had the when they came out with the figures that day on the call. That's what Mr. Saksham said. That's for Tesla basically.
Okay, I'll check that then. I must have missed something, because I was reading the transcript. Okay.
I mean, that's all from my side. Thanks a lot, but great presentation. Thanks.
Yeah, thank you, Sanjay. I'll check back and get back to Puneet as well. Yeah, Tata is for Tesla as well. Yeah, I got only Tenneco that time. Actually, Tata is also for Tesla.
Actually, he mentioned that in the this.
Yeah, it is in the con call script.
He mentioned in the con call it's for Tesla.
Yeah, it is for Deepak Pandey's question. I missed that question actually.
Yeah. So, and also one thing, this Foratia now is filing Chapter 11 in USA, and Foratia is one of their clients. Plus the EV magnet. Do you think it affects their supply, or will there be a problem for that, given that EV ka magnet ka issue aa raha hai, plus Foratia is filing Chapter 11 in the US? So
honestly, I don't have such a high level of knowledge of auto things.
ठीक है sir. Thank you very much.
Thank you, and thanks for letting me these things know. I'll research more on these things. I read a lot about Tenneco, but not about Foratia, because Tenneco is the largest customer for them actually.
ठीक है sir. Thank you sir.
Thank you, Kamalji. Thank you, Sanjay, for your inputs. Any other questions? Please put on the chat for Kamalji, and he will take it from there. And we'll move to the next presentation. And it's my turn now. Let me share my screen. I hope it's visible now. Can someone confirm?
It is visible.
Sure. Okay. So let's start. My theme is recycling, and let's start with how many of us are guilty of buying this small packs of beverages or chips or namkeens, or using food containers in the recent years. Maybe we might have seen the plastic bottles in the social gatherings, too much 5 rupees, 10 rupees bottle. The times of using a glass and drinking water from the this jug has been gone away. basically, and spreading waste in name of tourism, right? All we are guilty of all these things. And what's the outcome out of this? We are creating a urban waste. It's a growing challenge. And on top of it, low coordination among the waste collection and organized recyclers is making plastic a difficult life for us. And later on, what happens? Congesting sewage lines, municipal networks, and public utilities, affecting water flows, rainfall drainage, and public convenience. So it is impacting our lives back because of what we are doing on the top. So whatever it is, bottom line is plastic is there in our life to stay. And that's where my theme is investing in opportunity in the recycling industry. And presentation is for educational purposes. It's not a kind of buy-sell recommendation. So any gains or losses, please do due diligence at your site itself. So what is my thought process? I just want to get to this before I go to the stock itself. My thought process is here, catering to the long-term need of the people in industry. The company should be in evolving landscape and expanding industry. The scope of opportunity should be a little bit bigger, maybe a small size fish in the medium pond, or maybe a medium size fish in a big pond, expanding pond basically. Promoter should be a little bit hungry with low debt or reasonable debt to equity ratios. Pick and shovel investing, which requires to look for the industries which are suppliers basically for the end products. And then if I found all this criteria possibly, heads I win, tails I don't lose much. And once I understood all this, possibly thesis becomes easy to follow and share with the people. So this is my thought process, and we'll try to fit in whether my company fits into that or not, or can it give alpha to me? Can we have a long-term affair with this company, basically? So the company, I see one such opportunity in the recycling PET for the next 5 years. The company name is Ganesha Ecosphere. Current market cap is around 3,900 crore. CMP is 1560. So I just have a one single technical chart also. If you see one thing which is very, very clear for this company, and it is the dividends. Dividends is continuously flowing from the time it is there in the market almost. So it's a dividend paying company as well. So let's dive and understand whether it fits our criteria or not. So what is PET waste? PET waste is referred to the waste materials coming out of your plastic, which is like bottles, containers, packaging, textiles. But why we are using this PET at all? If it is causing such a waste? Because of its durability, transparency, and lightweight properties. And that's why it has become a popular choice for us. Now, since we are using it thoroughly across the domain, so what is happening is the waste is getting accumulated. And this is a significant component of the municipal solid waste. And it is non-biodegradable. If you just leave it, get it decomposed, it will take 300, 400 years to decompose. And that's where, if this PET has a recyclable capability, and that's what it has, we can convert into the products again, and maybe use the fibers, textiles, or packaging material again with the recycling PET. So this is where we are going to. And this industry has grown a preference because of its multiple properties like flexibility, simplicity, durability, and recycling capacity. So every industry, whether it is food and beverages, whether it is pharmaceutical or some other domains also, they have started using this PET packaging for the same reason. And they're replacing the virgin plastic, that is what it is, the first made plastic, with the recycled alternatives in the supply chain. If you see the right-hand charts, basically, Indian PET bottle production is almost growing by 10% CAGR. If we see the lower left-hand side, Indian rPET market, the volumes are going to be humongous in the coming years. And now just reflect back on what you are doing on the daily basis in your lives, in your homes. Just think of the small things which you are buying, which is made up of PET. And that's where these volumes will keep on growing, and we'll come to know in the coming slides why this is important for us. About the company, this is a company which is engaged in the manufacturing of the recycled polyester stable fiber, dyed yarn, dyed texturized yarn, and recycled spun yarn. This was the original business of this company, which it has been doing for so many years, taking the plastic and converting it into fiber. Recently, in the last few years, it ventured into the recycled PET chips or filament yarn, and from that, it is moving towards from a normal textile to functional textile. Functional textile, then filtration and fillings for the pillows, doves, toys, and food and beverages packing. Recently, company has also launched its own brand, Go Revise. What it is trying to do? It is manufacturing the products out of this. So just imagine what a company is doing. First, it is collecting a waste, recycling it, and previously it was selling only to the textile companies. Now it is going and taking a step further and doing the rPET chips recycling itself, which should be used for the bigger value addition products. On top of it, it is moving to a direction which is making the products itself instead of supplying to the others. So it is getting integrated, basically, all these steps. And this is where I'm getting interested into this company specifically. Strength of the company, largest PET bottle recycling company. How much? How much large it is? 16 to 18% of the India's PET bottle waste is recycled by this company. 16 to 18% of whole India's. It's a big number. Single company is capturing that. Largest manufacturer of the recycled polyester staple fiber also. 3 generations already into the system. 3rd generation has already taken the charge. And we have all the necessary certifications where the recycled things is going back, whether it is food and beverages or pharma. Those certifications have been in place. Now, company has this 3 decades of experience, 6 manufacturing facilities, 400 plus customers, 300 plus suppliers. So you can see the pieces are being fitting in. If you think it is a puzzle, pieces are being fit in, and it takes a lot of time to fit in each of the piece. And over the years, most of the pieces have fit in now. And the capacity which it has is almost 1,96,440 metric tons per annum, which is the largest, which is minimum 2 to 3 times of the nearest competitor it has. So none of the other competitors is around 1 lakh also. It is somewhere around 70, 80,000 now. So the capacity is also humongous. Company structure is something, it has recently started having this EcoPet and Ecotech companies, where they have developed this plant specifically for this rPET chips, along with the previous whatever they are trying to do in the old traditional business. On top of it, they have used this plant for these specific purposes. And in the Go Revise, whatever they are making rPET chips for bottle grade or textile grade, they are partnering well. Important point is, or differentiation is, the quality of these products is almost similar to the virgin products. And this is where the industry is getting aligned with them, because they are getting the right quality after the recycling. You cannot differentiate between it is recycled or not recycled. Previously, if you go back a decade back, possibly the recycled copies or the recycled fibers or recycled your textiles, basically shirts and other things, you can differentiate. It is recycled, it is new. Now you cannot. And because of this differentiation, because of this technology, the things have started going in their favor. And if you see down, out of 1.96 lakh capacity, the other capacity which they're building, this is the new business which they're trying to do, the bottom one, rPET granules, chips, PPSF, and washed flakes. This capacity is going to be growing in the coming years as well. And already out of 1.96, they are serving almost 75,000, which is the total capacity of the competitors itself. So it is having old business plus new. They are moving from old to new as well. And this is where I will share why I'm interested in this affair. What is the growth triggers? So my growth triggers are divided into 4 parts. First part is, what is my total market size? So if you remember now the first slide, what is my thought process? Is the industry is growing? Is the pond is growing itself? So the pond is growing by a minimum 3 times. This is what the approximation is. Currently it is 0.9 million tons. It is going to be 2.8 million tons. The full pond is growing in next 5 years. On top of that, Indian market, which is at only $0.8 billion in terms of USD, will be growing at a rate of 20%, which has grown by a rate of 20% in the last 6 years, is going to grow by 35.8% as per the research reports. So pond is growing and the Indian market itself is growing, out of which this company is aiming to capture 10% market share of that pond, which translates to roughly 2 to 3 lakh tons of the rPET annually. What is their total capacity at this point? 1.96 only. And out of which they're just making 42,000 usage out of that. This 6 to 7 times change they're trying to capture in the next 5 to 6 years. So pond is growing, the company is trying to become big by capturing that pond. So part 1 and part 2 are a little bit linked together with each other, but this is where the direction of the company is. At the same time, a company can grow, but the stock returns may or may not grow. So you need not only the company to grow in terms of sales, but operating leverage should come into the picture. So this is where, when they're trying to shift from the cyclical textile industry to the FMCG clientele because of all these recycled products, which is bottle grade or the food grade, they are moving from a low entry barrier to a value added high entry barrier business. So they are getting the technologies, they're using the machines from Europe. So there is a company, I would possibly give you as a reference somewhere in the later stage. So there is a company which manufactures these machines. And Ganesha Ecosphere uses those kind of machines. Now somebody who has the money and want to start all this work, and if their preference is that company to get this machine, it takes more than 1.5 years to get that machine itself. So you are already delayed by 1.5 years if you just want to jump into this kind of a mechanism itself. On top of it, a company which is already into that domain, having the machines, having the plants, have done the capex before and already identified the market and coming out with the multiple steps of recycling the rPET and then building the products itself, has a good advantage, good start ahead basically. Then part 4 cannot be missed. What is part 4? Part 4 is innovation in the recycling technologies. As I discussed, you're getting a high quality and cost effective rPET. Now, another part is, are brands adopting to this? If you're telling them, this is my recycled PET, are you ready to take from me? The important is brands are adopting it. We'll see in the coming slides which are the brands which are adopting this in their normal products itself. On top of that, a bigger change, the biggest trigger which I got for this company is the extended producer responsibility in plastic packaging waste. So India has come out with EPR policy starting from 2025, 1st April 2025, where it makes mandatory for the producers to adhere to this policy. What this policy says? This policy says you have to use certain part of your product from the recycled materials. You have to make those products with certain percentage usage of the recycled materials. And whatever you are selling, certain part of or certain percentage of that sales has to be recycled back. So this is what the responsibility is coming from EPR policy. So these are 4 parts. Then we'll go a little bit deep into that. So EPR, this is, I am calling it as a game changer. This is just starting for this company. What it does, it's an approach that places significant financial or physical responsibility on producers for treatment and disposal of post-consumer products. Once you have used it, what happens to that product? That responsibility lies with the producer itself. So all the producer, importer, or the brand owners have to comply with this. It covers a wide range. So we are today discussing about the plastic waste, but there are other policies for the battery waste, e-waste, hazardous waste. So you can go and find those companies itself. One of my other very good multi-bagger pick in the recent years has been Tina rubber. And that is also because of EPR. The tires has to be recycled back and the responsibility lies with the producer there itself. So that's where my Tina rubber also was one of the good picks at that point of time. And the journey has just started for these kind of companies. Now what it does, it makes sure that you have a collection mechanism, you have a sound recycling policy, you are meeting the recycling targets, and also you are creating a public awareness campaign. On top of that, you have to obtain the certificates from CPCB, and mandatory annual compliance has to be done. Now, there could be regular audits, regular inspections, and the regular fines are also coming up. Now, there is a chance somebody will be ready to pay the fine and not implement this policy. We'll discuss about those kind of risk also in the coming slides. But this is what is, I am calling it as a game changer. Now, I just went to the site of government where all these applications has been taken into account. And I see that if we just see the number of applications from the brand owners, producers, importers have been in place. So if you see the start has been done and the number of producers or the brand owners which has registered for this and approval is in process is little bit difference is there, basically 10 times the difference. The moment all the people who have registered for it started going for the approval process, you can imagine what is the kind of recycling content we are looking actually in the coming years. So this is on the producer, importers, brand owners, and this is on the plastic waste processing basically. Now, producing is one part of it, which Ganesha Ecosphere is not doing right away, although they have come up with their brand Go Revise. But most of the other companies which are lying there in the PWP space, this is what the Ganesha's Ecosphere space is: plastic waste processing. Very few companies are there who are capable of doing end-to-end kind of things in this space, and they have already taken those certifications basically. Now coming to the brand's adoption, if I go to H&M, Zara, being human, they have opted for it already. Recently, I went to 2 weeks back to some mall, and I incidentally just went to Zara for some reason. They have labeled it. This is made out of the recycled product. This is what the content of it is in that, and it's a commonly displayed. If you go 5 years back, it was a shame to put as a recycled content in the stores. People think it's such a big brand is still selling a recycled product, will not buy it. That perception has changed, what I see over the years, and the last 1 year has been quite aggressive on that front. If I go to a little bit on the global side, Stella McCartney, so Ocean Plastic has become a part of their brands basically. Nike Flyknit shoes, each shoes takes 6 recycled plastic bottles. Jockey Eco Comfort collection is coming out of the PET bottles itself. If you go to Doodle in India, all this they are taking the industrial waste into the fashion products. Indian Oil Corporation has committed for recycling 100 million PET bottles. Modi's jacket, it is composed 30 to 40% of the recycled plastic bottles. So things have been changing both domestic front, in the global front, and at the fashion retailers also. On top of that, if we see prioritization of the ESG in the corporate policies and MNCs are also driving this demand at the background. So the part 4 becomes more important. If I go back to that slide where I'm talking about these things, part 4 becomes more important. We have the biggest trigger in terms of EPR, and we have brands adopting to it as well. So that means somebody who can adopt EPR in their process as a producer should not worry about whether this could be sold as a product or not. There are people who are willing to buy it basically in the background. So this is where it becomes very important that brands has to adopt the brands which are well known for the fashion basically at the high prices. They are adopting it. Now, Coca-Cola. I don't know how many of you have seen this, but most of the Coca-Cola bottles are starting coming from this recycled PET bottle. And this is one of their major customers in the recent years and adopted this rPET for their production. And this is the customer which has driven them to go for the capex for another round basically in the coming years as well. So they have collaborated with Coca-Cola for all these cricket events in the past 2 years. They have partnered with the control union for the traceable collection of the Himalayan waste. So if you have heard it correctly, in the longer run, people do the trekking towards the Himalayas and left a lot of waste because it's difficult to carry in an environment where the oxygen is low. So they were just dumping it there. So this waste collection has to be controlled, and that's where they're partnering well with the right people. Partnered with another recycling company, Race EcoChain, and they have taken a stake there basically. And it helps for the traceability part of it. And this is one of the objectives of the EPR policy also. Another company, Manjushri Technopack, is also one of the leading manufacturers of the PET preforms. And if these companies are being tied up, I think something is really a game changer happening in the background for that. Now, one myth which people have, is it one time recycle or multi times recycle it is? So the myth is people think it's only one time, but it can be done multiple times. But after a few cycles, maybe 3 to 4, you have to add some part of the virgin plastic into it to get it recycled better. But it can be recycled unlimited number of times. And if you keep the content of the rPET towards 30, 40, 50%, it can be infinitely recycled actually. So that means every new product can take a content of around 50% as a rPET. And that saves a lot of plastic, right, for us on daily basis. If you just look back and what you're doing of using that plastic, and if you cut down by 50%, it's a good amount over the world basically. Now, a little bit going towards what they're trying to expand, they're investing 725 crore rupees, which is almost 3 times of their capacity expansion. Their current utilization is only 65%. So current capacity doesn't tell them to expand. But what they're looking, because of this EPR policy, the brands adopting towards it, the customers which are coming to them, they are seeing that if they don't adopt it right now, somebody else will come and take it away from them. So for serving the growing needs of the population, they are starting doing this expansion right away. They have done the warrants plus QIP to fund it already. It's not something which is not funded well. It's funded. So in Warangal, they are doing the brownfield, and Odisha, and they are doing the greenfield. And within 1 year from this point, maybe 1.5 years, these things will be ready. It could be an execution risk, possibly, because somebody is doing a big expansion, it might get delayed. This company came into my radar also in 2020. And that time also they were doing some expansion where we are talking about the Ganesha Ecosphere or another subsidiaries basically. They have done it well actually. And the price has moved from 250, 300 to already like 2000 rupees earlier. And in recent times, it has corrected. So the company has proven it in the past that they can do the successful expansion. They can go towards the product which the world needs basically. And tracking this company from so many years, now I have built that conviction out of it that this is one of the good companies in the recycling space. Benefits, yes, they are trying to capture the growing demand of rPET in the bottle grade and focusing on increasing market share in technical textiles. We talked about it. Unlocking the potential of high margin products basically. So the moment that they go to the high margin products, this value addition will become 65% of their total sales basically, and that will increase their OPM. So not only sales will be growing, but their OPM is also expected to grow in the coming time. What they're trying to do to reduce expenses, they are shifted towards the renewable energy, and they have done the rooftop solar power installations already. Some of the facilities are using 90% of the recycled water itself. So this company is not only just trying to make the products towards recycling better, but also adopting recycling in its operations by using the recycled water or by using the clean energy out of it. So all this can, because if your sales are increasing, OPM is increasing and the expenses are decreasing, possibly we are looking at higher margin in the coming years. So this is one of the other theses which I have apart from the biggest triggers we just discussed about it. So promoter itself have bought around 14 lakh warrants at 1035 rupees recently. I think it's 17 July 24. I mistypoed it to 25. And QIP done to the bigger players. at around 995 rupees. So we have a base basically. We have almost 50 lakh shares, somewhere around 1000 rupees as a base, where the big money is invested. Total money which they have got is around 500 crores. Investment is around 725 crores. Something will come from the internal accrual also. And the capacity they are going to increase by almost 1 lakh more. 90,000 to 1 lakh more basically, which is more than the capacity of the nearest competitor. So they are making it much further away. So it shows me promoter also has some skin in the game by putting a big amount of money at 1000 rupees. And big money is also showing interest in the game at this point. So it covers like pond is expanding, company is expanding, your margins possibly will expand, and promoter also has skin in the game. Now, what are the other strengths? We discussed some. They have a strong collection network in the background. They have the right joint ventures and partnerships with the other companies, onboarding new clients every year, moving towards the validation of products. Then go revise, which is still in a very nascent stage. So they are trying to sell the products now. Is in a nascent stage. We don't know how much revenue will come out of it, but definitely as the things will move forward, this will take a shape. And then they're trying to increase the exports. Currently, it is very less, 9% of the revenue. Tariffs might not hit directly at this point of time from US. But definitely in the coming time, if the exports are increasing, again, the margin can impact positively. And then they have the best PET recycling technology providers on top of it. So company is in the right pond, opportunity pond is also growing. Fundamentally, I see that cash flow from operations is reasonable. I would not say that it's an excellent thing, but it's quite reasonable. Tax rate is quite stable over the years. Sales and PAT is growing. Debt to equity is in control, despite such a huge capex they are taking. And then the bigger hands, promoter, DIA or FII, have close to 70% shareholding. So pretty good number of people or big money is invested into this. If I look at the chart, almost the stage 4, it looks like over and trying to form a base again with the stage 1, and possibly at some point of time it might again break out, or it might go to or continue the stage 4 also. We are not sure. Currently the charts are looking that it is getting consolidated at this point of time. Convergences are happening, and maybe wait for a quarter or two before it takes a jump. So it might be in a consolidation phase for some more time. Basically, that's what the chart is implying to me at this point of time. So this is one slide which you can see once I share the PPT to you on the key Indian peers basically, and we see that these are the nearest competitors which have almost 75 or 72 as the capacity, where our company has 1.96 lakh as the capacity. Now, what are the risks? See, does everything seems good? Or some risks are there, basically. I'm just looking from the angle that once we started the discussion is, can it give me alpha? Now, I have to think of what can knock off my alpha returns, basically. Or is this affair sustainable or not at all, basically? So first is the EPR compliance, right? Companies can say, I'm not using the EPR, I can delay it, or poor enforcement can happen, basically. That can lead to usage of virgin plastics only. So it's a medium kind of a risk as per my assessment. Although there are penalties, and penalties are increasing with each default. But if the oil prices remain low, if the oil price remain at $20, $30, $40 in the coming time for some reason, then there is a big gap between the rPET price versus the virgin plastic price. And companies might be okay to pay the penalties for some 1 or 2 years before the oil price jumps up. So this delay is not captured in the current price. This is a unknown kind of a risk, although people are aware of it, but when it will hit us, we don't know. So this can potentially delay the returns basically in this company. Another is capacity expansion, which I discussed that it has proven it earlier, and again it is taking a big expansion. Looks like a risk, but it needs a close watch because it is proven it before. Third part, getting the raw material. So you need bottle to recycle it, right? And if the bottle price is increasing, basically, the Raddiwala, which is selling to the company, says, I cannot sell at a low price. So this price volatility can impact the margins in each quarter. So you cannot think of each quarter is 13%, 14%, 15% is coming. It depends upon the raw material prices, which in this case is PET bottles for you. If other competitors starts offering bigger price, or the export side, they started sending more outside towards the US or Europe, possibly you need to bump up your raw material cost itself, which can hit the margins in the short term. Then the gap between virgin and rPET granules, as I told you, it depends upon the oil prices. Traditional business, the bigger risk I see is a traditional business risk, which is going down. So the new business has to overtake this business. And at certain point, this break even will happen and margins will start improving further. So this is one field where I see that it will take 1 or 2 years. Then this industry doesn't have long-term contracts. So even though Coca-Cola is giving them the benefit of getting the products through recycled way, but it is not giving them a contract for 2 years, 3 years, 5 years. So this is what it can stop to, although they have expanded it well by next year, but what if they don't have the right sales basically coming out of it? So possibly the factories may remain empty, unutilized. So capital allocation might become a good question at that point of time if this happens. So this industry is facing this challenge of not having those contracts. So I see it as a risk. Now, what is the real moat or deal breaker? If I just summarize the whole PPT, so one of the real moat of this company is getting the waste collection at a large scale and processing. Tomorrow I want to start this company, I need to build that network. Having the waste collection from different sites of India together at a certain price and process it and getting a customer on the other hand. So if I'm on the right track, these are the two possible things I would be keep on looking in the longer term. And what could be the deal breaker for me? One of the bigger risk is the big brands started doing their own chips manufacturing. So they build their waste collection because of EPR policy and start building those rPET chips in-house and not taking from Ganesha Ecosphere. So the whole industry cracks down and the big brands started doing them themselves itself. So this could be a deal breaker and I should get out of this company at that point of time. Or EPR policy not taking off due to extended low oil prices could also be a deal breaker because it will be dead money for some period of time, right, from that angle. So does it satisfy my criteria overall? I think it is satisfying the long-term need of the people, yes. Evolving landscape and expanding industry, yes. Scope of opportunity, yes, it is bigger. Promoter has shown skin in the game. I have reasonable fundamental ratios, kind of a pick and shovel because it is supplying to the products. Thesis looks simple. A risk I understand and are under control as of now, but heads I win and tails I don't lose much. So what is the valuation part? So coming to the valuations, I am looking at 5 years down the line. I see it's not a 1 year story or 2 year story. It's a 5 year story somewhere, and expecting a CAGR of 20-25% for 5 years. Somewhere we'll land in the sales of 3,400 to 4,000 CR with a PAT of 300 to 400 CR. Assuming the PE ratios with the company is growing around 25% to 30 or 50 based on the bull market or the consolidated market, which is going on in 5 years down the line. I cannot judge it, but I can assign certain numbers based on history. So I see that the market cap can go to 9,000 crore or 20,000 crore. Quite wide range, but it is, if you look at the current sales, what it is and what we are expecting in the years down the line, it's kind of 2x to 5x possibly in that. And the market runs ahead, you need not to wait for 5 years possibly. You might need to wait for 4 years from that angle. But what on the other side, if it doesn't achieve anything, what is the downside? Downside is it just grows by 10% every year. This industry is still expanding. Make no doubt about it. Industry and the pond is still growing. This company will still grow, but maybe at a lower rate. And having some projections from the other side of it, I see that this is all priced in and we might lose some 25%. But if I lose 25% and I have 5x gains on the other side, it possibly, to me, it looks like a good risk reward ratio. So that covers my last point of heads I win, tails I don't lose much, possibly yes. So I let my affair begin with this. And before I leave, just few thoughts. In the market, most important organ is the stomach and not the brain. We all have the brains to identify the things, but we don't have the stomach to carry it on for a few years. Since the potential which I'm discussing is for few years, not few quarters. And then are we willing to do a little bit of work? I think if somebody does it, he will be able to find the right stock. And on the other end, I am trying to buy the companies which are selling the bullets in the war, not fighting the war myself. So when I share this with all of you, there are certain other things which you can read, but we can have the Q&A if somebody has any questions for this. Any questions, guys?
Mohitji, it's Yogesh this side. Congratulations again on this very good presentation. It's their Nepal plant operational fully?
So Nepal plant is also coming up. So the third plant which they are trying to do is in Nepal, which they are trying to go internationally with that plant. This is written here. So this is commence something, but it is not clearly reflecting the big numbers and the current revenue at this point of time.
Yeah,
And
because from my reads, Nepal plant will have, will fetch some good margins because of, low labor cost and, good raw material pricing. There is no competitor absolutely. In India, you listed many, but in Nepal, they don't have, that major, competitor with that technology advancement there.
Yeah.
So the Nepal one was, very important.
True.
Yeah, that's from my side.
Okay. So
Yeah,
any please go ahead, sir.
Yeah, Puneet, is there any risk like about Nepal plant? Like now you can say relations are not that good in Nepal. Can it impact this? Because now China is also interfering in that, and the new government in Nepal is.
That risk is very, very minimal actually. So one of the other opportunity which I have not captured and possibly that can start reflecting in a 1 year is the free trade agreement on the textile part. So most of the things are moving from from other countries to India, and India textile owners are supposed to benefit. And in those textiles, if you're trying to get the recycled content to basically, so this company can gain big from that instead of having that risk from only the Nepal operations coming out of that.
Right.
So both that part I have not covered currently because that are not very clear to me from that angle whether I should capture the FTA also in the current slides and the Nepal risk. But I see Nepal risk is quite minimal from that point.
And any other area they are planning to get into, or only the technical textiles?
So I think I have captured somewhere they want to move into this. This household textile sector basically.
No,
so
textile is okay. Otherwise, any other sector like.
So this is so one is the toys basically recycled toys. Toys is plastic, right? In that the concern for the most of the families is you cannot have the bad plastic going to the children, and that's why you are going to the very, very big companies in terms of having the right toys for their kids. Now, if you have the right technology, which is giving the right content in the plastic, which is as close to the virgin plastic itself with the right quality, I think it's a very big market which is opening up in terms of toys. And this is what it is towards. This company is also supplying to that slowly.
Or any other health risks of the recycled plastic, or nothing as such?
So yes, they're supplying to pharma and healthcare already. So if I choose one specific product, I cannot name it, but definitely there are clients in that sector.
Okay, that's fine. Thank you.
When they are building aggressively the capacities to a 6x, 7x, what would be the risk? Because if the utilization does not pick up in a later stage after the capacity expansion, what would be the downside impact of that on the company? Because they are spending capex and fixed cost will be higher on that time, right?
So that's what my last slide is. Make no mistake that this company will still be growing basically. So the pond is still expanding because a lot of companies will still look for the recycled products. Although capacity utilization might remain low, but it cannot be zero. It might remain 20-30%. So what will happen? The company might not grow beyond maybe 10% instead of going at 20-25%. Possibly depreciation might take an impact for a year or two with the higher numbers because sales are not growing. So bottom line might be impacted with this depreciation part of it. New machines are coming, right? They will keep on depreciating for the next 2-3 years. So for 2-3 years, you will not see gains much out of it. But this is one industry which I think is not going to get down. It belongs to sunrise industry basically. And if I just take a bigger horizon of 5 to 10 years, I think it will do well. It's just a matter of whether you can get it at 1,000 rupees at this point of time or you buy it 1,700. That might change the amount of returns which you will get from this company. So just try to get the buy at the right price and possibly you will make good returns out of this, despite having all those risks which you mentioned and I mentioned.
And the technology is expected to not to change in the next
It
2
will
5
keep on
years or
changing,
6 years.
but they have a good technologies in hand because they are tying up with the best of the companies for the recycling part. Already they have done this. And one of the other companies they have tied up in 2022, if I remember, is the which gives you the traceability of it, from where you are getting the things, and it establishes the trust with the companies, right? Because you might tell, I'm giving you the right product, but from where it is, that traceability, not every company has it. This company has that advantage. Some patent is there. I think it has tied up in 2022 with somebody. I will check and
Adnas
get back to
US.
you.
Adnas US.
Possibly that was the one. So from that angle, I think if you see 2022, 3 years back, they have thought about it. So even if the technology change, I think the promoter, third generation is into this industry. They would come to know of it much before and they would possibly adapt to it.
Okay.
So yeah, rest of the questions let me take in the chat. I will give the floor to Samarth. He is waiting already. We are a little bit running late today, but I think you all guys are enjoying, not complaining. We are late by 30 minutes, I think, today. I will share this. Please go and read something more about this company. So some references also have mentioned from where I have taken some of the inputs, studied about it. You can also go. I will share some of the quizzes about this recycling part as well in the group. So please take it up. I will stop sharing here. Thanks all for your patient listening to me. Yeah, Samarth, floor is yours now.
Yeah, thanks, Puneet. Am I audible?
Yes, you are.
Yeah, the screen is visible to everyone, right?
Yes, it is.
Yeah. So first of all, thank you for waiting, everyone, and a lot of good presentations. And thanks, Puneet, for giving this platform. So just a standard disclaimer. I think I'm not a SEBI registered advisor, and this presentation is only for learning purpose. I do share my thoughts very often, so this is one of them. And we are invested in the business from a very long time, and I see immense potential. So would refrain from actively discussing about the charts and the valuations, but yeah, I would take you through the business. So I won't take a lot of time. It's lunchtime for everyone, but I do hope that this is engaging for everyone. So the business we'll talk about today is Windlas Biotech, which is from the CDMO formulations industry, and it's primarily focused on the domestic pharma. So if we understand this industry and as we go forward, this is the value chain, the pharma value chain. You have the innovators, and then once the patent expires, a lot of generic medicines come in the market. So there are two parts to the generic medicine. You have branded generics, and then you have trade generics. So Windlas major revenue is from CDMO formulation, which it does for a lot of big pharma players. So it is one of the top 5 CDMO companies in the country for domestic formulation, and primarily it focuses on two parts of the value chain, which is one is formulation development, wherein the drug efficacy and everything resembles the original drug once it goes off patent, making it more affordable. So it manufactures that and then it markets that under the name of Windlas Biotech. So these are the 3 verticals if we see. So if you see the CDMO vertical, and there are three parts to it. One is that there are certain companies which do the API manufacturing also, development also. So API is a key material for that, and then their margins are more. There are certain companies which develop a lot of products for international markets like US and developed countries basically. So there the margins are high, but the asset turns would be lower. And then there are certain companies which are very much focused on the domestic side of the business. So Windlas, as of now, you can predominantly say it's a domestic CDMO formulation oriented company, and they have three verticals. One is the vertical. So I divide Windlas into three things, which is how I see the business of Windlas. So CDMO vertical is something wherein they had heavy contribution a few years back, which has now come down to maybe 73% of the revenue mix. Margin profile wise, it has the lowest margin amongst all the three verticals, but they still have decent margins because they hold the intellectual property rights for the formulations and everything. So they are able to retain those margins, and the margin profile are not very clear what is the kind of delta between different verticals. We'll discuss that also. So if you take the management's focus, 2001, the company, 2021, the company got listed. And over the years, they had a aspiration of growing the CDMO vertical by 2x and the trade generics, which is the institutional part of the business, also by 3x. And then the exports making it 4x. So CDMO vertical, just a glimpse. So their top 10 customers revenue percentage has come down, which points out that they are gaining new customers also, and client concentration is not that huge. Trade generics is the vertical which is the fastest growing vertical for them. We'll discuss about trade generics also as to how this vertical operates, and it has a higher margin profile than their traditional CDMO vertical. And then there is exports, wherein they are eyeing the semi-regulated markets and all those markets, and wherein the gestation period is a little high. So it has been a little tepid growth for them over there. So these are the three verticals, and of course exports would have the highest margins for them. So if we dissect the blocks for Windlas Biotech, how does the industry look like? So it was a fairly easy business for me to understand, not being from pharma background. So the industry of CDMO, right? So with the kind of lifestyle diseases increasing and diseases increasing across, I mean, affordable medicine, or not everyone can, afford expensive medicines. So industry landscape, if you see for the CDMO industry also within India, there's a lot of focus on bringing the norms that the manufacturing facilities are world class, and people get good medicines in India as well. So Schedule M came up in 2018, so which would benefit a lot of bigger pharma CDMO players, because everybody would want to go to the right facilities to get their drugs manufactured, the branded generics players, if we talk about them. Then the government of India has also focused a lot on affordable medicine across the country, in the hinterlands, in tier 3, tier 4 cities where there are not a lot of doctors. So trade generics as a vertical is picking up fairly quickly. And so as we can see that both CDMO formulation market and trade generics is poised to grow, and chronic and subchronic diseases are on the rise in India. As I said, lifestyle diseases. So what are chronic and subchronic? So basically cardiovascular diseases, diabetes and all these. And then you have the acute part also, which are your cough and cold and all these. So Windlas has its major revenue from chronic and subchronic, 59%. They do not give the bifurcation of what is the kind of medicine, what percentage of medicines they sell, but this is how the split looks. In terms of their product assortment, they have complex generics, which contributes roughly 67%. So as the name suggests, the kind of formulation which is there is a little bit on the complex side, so the margins would also be higher, which explains that having the IPRs and everything, how they are able to sustain their good margins. So if we see the overall graph, I mean, what are the opportunities? So I divide Windlas business into three verticals, and this is how I see that. CDMO for Windlas is a stream business. That this is a business, the CDMO industry, if you see in India, would grow at 10 to 12%. And I'm talking about the domestic industry. So it's a regular business. They have been growing here by 13, 14% CAGR, few years up, few years down, depending on the capacity and etc. And by the way, they cater to almost 7 out of 10 leading branded generic players in India. Trade generics is the cream business, and why I say that, because the kind of growth which can come in revenue over here is immense. So it's a business of scale. As the network improves, as they get more stockists, they penetrate more markets, it can be a high velocity business for them, of course, with higher margins. And exports is the dream. I mean, why I call it dream is because it has still not materialized. They have been focusing on this business. It sits on a low base. What could be the challenges? As they expand into trade generics through their stockists and distributors, working capital cycle, which we'll talk about for Windlas Biotech, could get stretched. Plant 6 was another capacity addition which they were supposed to have, and it has got a little delayed. So it was supposed to earlier come in FY25 or by the end of it. So now it would tentatively come in FY26. So we could see some tepid revenue growth. And competition in terms of two other players also, which are recent IPOs by the name of Ecom Drugs and Innova Capital. They are also doing capex. So competition is also coming up with capex. So it might be that the bigger players might grow a little faster. So we'll have to see that. And fourth is their injectables facility. So this is the first time Windlas has got into a different type of dosage form. So they do oral solids. They've got into injectables. So this facility got a bit delayed. Now, this facility should give them higher margins, but would come at a lower asset turn. So it could take time. It could drag their P&L a bit, which it has done for this year also. So as we move to this snapshot, so this is how their year has looked like. They had their ever highest revenue of 760 crores, and they have hit 203 crores for the first time in a quarter. EBITDA growth, there has been a 20% growth in EBITDA, and we'll discuss why this is special for a company like Windlas. Working capital days have been maintained at 14 days. ROCE and ROE are in the mid double digits. Exceeding 20%, but there is a catch to it also. They have a lot of cash on their books. So if you put in cash and mutual fund investments, it would be a little dragged down. They have a very strong liquidity position as of FY25 end. And this is the kind of capacity expansion which has taken place for them. So in tablets and capsules, this is the kind of expansion. They had a plan to expansion and plan 6 is supposed to come. So they are right now sitting at 63% of capacity utilization, which with injectables yet to give them some major revenue. They had 6 crores of revenue from injectables. And this year, hopefully, the utilization for 75 crores odd of capex should materialize for them. This is their journey. So not reading much into it. They started with 1 or 2 plants. Now they are on the verge of having the 6th plant. As we can see, plant 2 extension has already happened. They have initiated capex for plant 6, which would again be a oral solid dosage only capacity expansion, which should happen by this year. The good thing about this company is it doesn't export to US, it doesn't export to Europe, but their plants are approved by European standards as well. So the company had started exporting to US, and then they took a conscious call. There were no observations. They said we won't concentrate on US because there are a lot of FDA approvals and everything, and they would be operating in the semi-regulated markets only. But the heartening thing to see is that they have approvals. Their plants are approved by the highest standards. They have added a lot of customers. They have big clients also, but they are doing client diversification. If you can see, they have 757 CDMO customers, which they have catered to by the year, bringing down their client concentration and building up the business. So this is the P&L statement. So I think if you see overall, the trade generics business, the way it is standing at more than 20% of the revenue contribution, and exports has not really picked up. So if you see, the gross margins have really taken off. If you see last year, the financial year which has just gone by, what we can see is they have a continuous improvement in the gross margins. They have very good accounting practices. And why I say that is because even as their capex was happening, they were taking a lot of expenses on the P&L. So if you see their EBITDA margins, they have retained in spite of that. The PAT was growth. The PAT was flat compared to last year. And a major reason for that is the depreciation cost, which you see coming from the injectables and the plant 2 capex, or the extension which has happened. So injectables has yet not contributed, but the kind of capex they had, the depreciation really took off. If you see here, the employee expenses have really shot up from this year, and there is a reason. So they have all their plants in Uttarakhand. All their plants are in Uttarakhand. There was a minimum wage revision, so which really ballooned up their employee expenses. But in spite of that, the company has retained its EBITDA margins. So this is how it looks. Good accounting practices, ESOPs are being given to the employees. It's a debt-free company, almost a debt-free company. They have some working capital requirements for which they have a little short-term borrowings on their books. But apart from that, that's it, what's there. And subdued PAT margins, as we saw. So if you see, the PAT margins dropped from 8.3% to 8%. And they were actually higher at 9% in FY24. So there is no reason to believe it cannot go over there again once injectable starts contributing and plant 2 extension has already happened. This is a consolidated balance sheet. If you see, a very clean book over here. They have done continuous capex at regular intervals. So if you see the management of Windlas Biotech, the good thing about them is they are conservative. The bad thing about them is they are conservative, right? So one has to see it from that perspective. They are a very professional management. So it's run by the promoter. So it was started in 2001, the company. Then the promoter's sons, they got into the business, who is the managing director, and they have the CEO, who is the person they have groomed from within the organization. So Komal, who is the CEO, she used to be the CFO, and now she has the dual responsibility of being the CEO as well as the CFO for the company. If we see, cash has been sitting on books, management has been conservative, so that could be one of the drags for the company. Good thing is it's a small cap company. In 2021 they did their IPO. 2022 they did a buyback also, and promoter did not participate in the buyback, which indicates they have skin in the game. And any additional capex, the good thing is they can do through internal accruals. Any inorganic acquisition, if it comes, they can do through their they have a lot of cash on their books, and the balance sheet is good to ride the turbulent times also. Their plants are all approved by the agencies and everything. And what Windlas actually does is it looks at a 2-year plan. So if somebody talks to the management, and if you have seen their communication with the stakeholders, they look at 2-year plan, and then that's how they plan the capex. So it's a very prudent capital allocation sort of a management, but which is borderline conservative also. So R&D key highlights the kind of expenditure. So you don't have to do a lot of R&D. You do the formulations and everything, but the kind of R&D which is required, they do that R&D. It is in line with the kind of percentage expense, the kind of Innova and the Ecom does. And just some glimpse of how they are. EBITDA margins are comparable to bigger peers. R&D spend is comparable. They are prudent capital allocators, and it looks like that the management has the ability to take it from small to big. Now, on this slide, I would spend a little more time as to how I see the 2 verticals of Windlas. One is the CDMO business, which is roughly 77% of the business, and one is the trade generics business. CDMO is, I think, right now 73%, and then the trade generics business. So the difference between trade generics and branded generics is that in branded generics, there are medical representatives from the branded companies who pitch it to the doctors, and then they prescribe that medicine. Trade generics is, it has the same salt, everything is there, but you are actually distributing it through the distributor. You don't need a prescription from the doctor. You go to the pharmacy and you pick it up. So trade generics has 2 aspects. One is the institutional side of the business also, which is the Jan Aushadhi, wherein you have these centers opening up in smaller cities. You can walk up and take the medicine. So Windlas does not give the split between the trade generics and the institutional business. In CDMO, if we see the high positives, there is a steady growth of 14 to 15%, as we discussed. It can grow faster also, being a smaller player, provided they have the right amount of facility for that. Schedule M should help them bringing organization into the industry. Injectables, a higher margin business and a different kind of dosage, should really help them scale faster with better margins. And then they have a lot of cash on their books, so they can actually introduce some new products, some other products, or some kind of dosage, or can do an acquisition to really ramp up their operations. if you see at the, if you look at the drawbacks in this particular vertical, the point is that if you see Windlas, they are committing that they can do 800 plus CR of revenue from the CDMO vertical this year. And Plant 6 has not come up yet. It is supposed to come in this year. So you could see some amount of top line, not very heavy top line growth in this particular year compared to last year, wherein they grew by close to 20% in top line. So we could see a 14-15% kind of growth in revenue, provided they are able to do 800 CR from CDMO and they are able to do around 60-70 crores from injectables, looking at an asset turn of 1x. In the trade generics business, the good part is they have demonstrated faster growth with good control on their working capital. So it's very easy to really stuff in the channels and bill to the distributors and everything. But they have actually kept a control over that, the collections and everything. Jan Aushadhi is a very big, could be a very big game changer for them. As they expand into more markets, more stockists, they could really penetrate the markets in a quicker fashion. So they have grown from a low base in trade generics. They could still grow faster on a higher base also. Quicker expansion, the same thing. The negatives or the drawbacks could be, at some point there might be a bottleneck in terms of expansion. Beyond a scale, if you have to reach, your financials might not remain as pristine, or there might be certain problems coming from new stockists who are not able to give you the business, or newer markets are not adapting to your product, because ultimately you are there in a wide sea. So if there is offtake in the channel, you cannot really control that beyond a point. And bigger players like those in branded generics might also, or the other players might also get into trade. So it might become a very cluttered market, wherein the consumer would not really care for the brand which is there, because branded generics are anywhere there in the market. So in the trade generics, nobody would identify maybe in a tier 4, tier 5 city whether Windlas is better. So whosoever is given by the druggist at the counter, they would have to take that drug. So these are the two key pillars for Windlas Biotech. Hitesh Windlas from the promoter group, who is the managing director as well, and Komal Gupta, as I said, who is the CEO and the CFO of the company. So she got promoted in 2023 as the CEO as well. Earlier she was the CFO. So how could the business look by FY28? So I have taken a very fairly conservative estimate on the business scenario as well. So this is where we are sitting at right now, 760 crores of revenue. This is the split. Let's assume they can do 800 crores of revenue, which they are saying by the CDMO plant, which the already 4 plants which were there, or 5 plants which were there, and injectables also comes in and contributes 60 to 70 crores. So we can see that we might grow to 878 crores top line in FY26, 1000 crores odd by FY27. And provided Plant 6 is there, it starts contributing, not accounting for any new capex, they could be sitting at a top line of around 1200 crores or 1160 crores in FY28. A fair estimate. Trade generics growing by 20-22%. It is growing by 30% right now, and CDMO might grow at 12-13% only. It could actually grow by 15% also. So I have taken fairly conservative estimates, and exports could actually double after so much of gestation period. These are some of the things which could really become winners for them. Injectables could become a success. Additional capex could take place over there in a shorter duration, because it might be a brownfield sort of expansion also. An acquisition becomes really accretive for them, and it's still a favorable prospect for shareholders. I mean, when they launched their IPO, so if you look at the history, it's a 4-year-old IPO, and it is 2x the IPO price. So there might be still some amount of price discovery which is left, and it's a business which is poised to grow until and unless something drastically bad happens. Revenue front, if we see, it could be a muted top line in FY26. FY27 could be 1,000 crore plus revenue. Trade generics could inch up to 26%, bumping up their margins. Exports could really take off again, being margin accretive. Same thing in FY26, the PAT could lead the revenue growth, which it has done for the past few years. Last year being an anomaly for them. Plant 6 also being completed, we could look at a forward P of, if I just say that I am at a PAT margin of 9%, which they have done in FY24, we could be easily looking at a forward P of less than 20, and it could even be higher. The PAT could even be higher, and it could be much cheaper at present value right now. On strategic front in FY27, there could be more capex announced, because whenever they reach 50 to 55% of the capacity utilization, they tend to plan their capex, and with the new capacity coming in FY27, another capex could be announced, and acquisition could come up, a product launch or a new lineage of products could come up, and buyback could again come up if the valuations remain really cheap. So multiple options for the shareholders. And one thing is that slow capex or excessive cash on the books could become a drag for the company. I mean, the shareholders might look at what are the prospects for the company. So these are few thoughts. This is one slide I would love to spend some time, and this is how I have divided it. Industry structure, how does the industry look like, how are Windlass operations, and what could be Windlass strategy, current strategy, and how it could hit them. So if we see the current run rate on the industry structure, CDMO business is growing well in double digits, and the industry is supposed to grow at double digits. Janaushadhi could be a game changer. Exports to semi-regulated markets, their plants being complied and everything could become a game changer for them. They are approved by European standards as well. Risks are the capex could be a little slow as to what the growth in the industry is. Schedule M implementation would not be that beneficial to them. It could be slow, and the unorganized to organized shift might not happen in a very quick manner. Few established players could get into trade generics, and Janaushadhi, as we say that it's an institutional business, it could slow down as well. Windlass operations, if we see, their CDMO business is back to double-digit growth. Trade generics, they have a very good network. They have very good accounting practices. They should get operating leverage coming in this particular year, with their wages also not increasing that much. The depreciation also would not hit the P&L that much, so PAT growth could be higher. Few risks are trade generics could be difficult to scale up. Plant 6 capex could get delayed, so we might look at that the capacity utilization might start getting commissioned in FY27 actually instead of FY26. So that could really make the revenue growth smaller. And the management is very frugal. If you see that the CEO, so it is very important. The management is very frugal, and it's a 2-team army as of now, it seems. So they are very heavily dependent on the 2 team members, and they are very good strategists in terms of running the business. But yeah, having a simple strategy of growing it very conservatively could hit them. Then Windlass strategy, they do capex when they reach 50 to 55%. They have a lot of cash. They have high margin business coming into gaining share, except the example, the trade generics, the exports, the injectables would be again a higher margin business, of course at a lower asset turn, and management rewards the shareholders. They did a buyback, they give dividends. Excess cash on books, yes, it could be a problem. Bigger competition could grow faster. The market always looks at higher growth, so it might be that Ecom, Innova, these players are able to grow faster than Windlass. Exports doesn't tick off for them, so it might become a sort of vertical wherein they have made a lot of efforts and everything, they have filed dossiers, etc., but it doesn't really take off for them, and being conservative could hit them, which we have discussed multiple times. So this is just a snapshot. Sales growth of 18%, PAT growth of profit growth of 30%, which has exceeded the sales growth. If I look at the currently also the PEG ratio is close to 1, but mind it that we have also seen that 1 year the PAT growth has almost been flat, so we have to take it with a pinch of salt. The actual ROE is much higher. So excluding cash, it is actually lower. So excluding cash, it is higher. So the metrics are getting a little dragged on, and the profit should again exceed the revenue growth for this particular at least, and maybe for a couple of years. And now from a technicals point of view, if I say, I mean, I would not spend a lot of time. So this is how the chart has been behaving for the last 1 year. And this is what happened after the Q3 results. When the Q3 results came out for Windlas Biotech and depreciation cost was very high, employee expenses had put a drag on the company, and this is where a lot of selling happened, and it recovered almost there. And again, if you see in Q4 also a similar scenario played out, but this time the stock did not experience the kind of downturn it had earlier. So it has respected the 200 EMA, which I fairly look at for the last 1 year, and a marquee investor. So there was some change of hands in post Q3 results. And here it is consolidating. It looks like a lot of investor meetings are happening, and a lot of them happen for Windlass. They have been happening, and they don't reveal the names of the investors. So they could be that we are looking at a 2-year forward PE of around 20, which might be actually lesser. They could be an acquisition and buyback plan too. EPS expansion could easily
Samarth, I think we lost you.
So this is how I see the business of Windlas Biotech. A very conservative management. They know where to deploy funds. They are very miserly also with deploying funds. So that's how I see it. A company which is a recent IPO and could do fairly well. So yeah. Any questions we can take up? Hello.
Yes, Samarth.
Yeah.
It's a very good insight into Windlas Biotech. I did not study this business before, but definitely gives me an opportunity to look again into this kind of a story and what could be the triggers possibly. And I think the chart shows that we will get a chance to buy it actually in the time to come.
Yeah.
Great. Yeah, audience, any questions for Samarth? So maybe we can look at Samarth in the chat possibly if people keep asking questions possibly at times. So if you can reply in the chat whenever you see it, that would also help. And any questions that come to me, I will forward to you also, possibly on the WhatsApp. From that, we can take it up.
Sure.
Thanks once again for participating and coming in. It's my pleasure to host.
Thank you so much, Puneet. Thank you.
So the time has come for the last audience poll for the day before we all wind up. So I will hand over to Amar again for the audience poll. So this time audience polls are more tricky as compared to the previous ALDs. Possibly people might be feeling no easy answers. So Amar, you can share your screen, and Samarth, you can stop sharing.
Sure.
You guys are able to see my screen now?
Yes.
Okay. So jumping on to the first question now. 1 minute time limit.
Yeah, go ahead.
I'm trying it, but I want it.
What is the main advantage that index funds have when compared to actively managed funds? Low risk, low cost, low price, none. Okay, I think we have enough answers. We can stop here for the first question.
I'll move on to the next question then.
Yes. We are done. I think we have the answers basically. Okay, so I will go through the answers and come back to you in the WhatsApp. Who has won it? for this audience polls. In the morning, Arun has won it. And for the afternoon poll, I will come back. Thanks, Amar, for taking it up.
Yeah, no issues, Puneet.
Yeah. So we'll meet again tomorrow around same time, 9:40, 9:45, and we'll start tomorrow again. 7 more presentations are there and some big shots will present. So today was a heavy day, I think.
No, looking forward to the third day also. Day 1, day 2 of ALD5. Means so many good companies, so many good presentations. So looking forward to the third day too.
Yeah. So what we have done is morning you get the companies, afternoon you study. That's how we should do.
Correct.
Okay.
Totally loving. Thanks, Puneet.
Chalo, see you guys. Thank you for all your time. On the weekend, I will stop the presentations here. Meet you tomorrow. Bye.